Okay, good morning, everyone. Welcome. Welcome to our event. All guests online. I hope you can hear me fine. I think it should work. If not, yes, okay, perfect. Welcome everyone here. My name is Hanna. I'm the head of the climate team here at ECDPM, and we have co-organized this event together with my colleague Sami Bilal, who will hear more from later, Daniel Ademi, and Jacob from University and from University of Utrecht. So the topic of today's discussion is enhancing European financing for adaptation to cascading climate risks. And it's one of the closing events of the CASCADES project, which is a Horizon Europe for Horizon 2020 funded project for 4 years, and it's ending at the end of the year. So in this project, we first looked at how climate impacts, such as droughts or floods happening outside of Europe, can impact Europe. Can have spillover effects in Europe. This can happen via security relations, trade, financial markets, migration patterns, and so on. And in the second part of this project, we look at how Europe can build resilience to this type of cascading climate effects. And one way is, of course, for financial institutions and development finance institutions in particular to better assess climate risks and integrate them into their strategies and portfolios. And another way is for these DFIs, for the development banks and MDBs that want to scale up adaptation finance to make it more efficient, more effective. And so these two topics will also be the topics of the two panel discussions we will have today. With COP28 in a few months, this debate is of course very timely, and we have seen that in the past months. The question on how to do this, how to scale up adaptation finance, make it more effective, and so on, has been topic of global debate. Now we have seen the summit for a new global financial pact in Paris in June, and the reform agenda, and so on. So climate adaptation finance is really high on the agenda, and that's why it's so important that we have this discussion. So we will have two discussions today, as I already said. And for the first one, I will let Irene, who will moderate, introduce the panelists. We have a few here in the room, a few people online. And I think we will start with the presentation from Giacomo. So please, Irene, and I think Giacomo, you will give the PowerPoint presentation. So maybe, yes, if you can come forward. Should be set so people online can also follow the presentation.
Okay, so good morning, everybody. Very happy to be here. I'm going to the people online and very happy to be here today and present our joint work titled Asset Level Assessment of Climate Physical Risk Matters for Adaptation Finance. And if we go to the next slide, or do we have a control sort of? Okay, I just. Okay, so where does this work come from, and how do we try to set the scene also for today's discussion? It comes from the fact that we still have main knowledge gaps that remain in the context of climate physical risk assessment, and these knowledge gaps at the same time hinder the capital reallocation towards the low carbon transition, and as such hinders the feasibility of the transition itself. At the same time, if we have delayed action on climate change adaptation and mitigation, we then risk to fail to close the adaptation gap, so the gap in financing for adaptation. So what will we go through today? We will go through a methodology for asset level physical risk assessment and evaluation of securities and financial portfolio risk. And we will show how the risk emerged from the interplay of acute and chronic risk, and also from the importance of assets and revenues across the firm's supply chain. And lastly, we will show how neglecting this asset level dimension of the assessment can lead to severe underestimation of risk. And if we go to the next slide, And we can see the gaps that exist on the current scene, on the current theme. And we have identified four main areas. On the one end, you have we have the asset level data. So the point is that we have missing data at the level of plants owned by firm. And especially we have problems because these data are generally non-standardized, maybe some exist, but they are proprietary, and they are generally not consolidated. Secondly, even when we do have information about assets, so location of the plants, we don't know, we may not know who owns them, or we may not know the ownership chain from the asset to the global markets. And lastly, there's a long discussion about whether physical risks are actually priced in financial markets or not. But currently, the discussion is mostly focused on past disasters, and on the other end, there's a lot of contrasting evidence. So these three challenges kind of lead to the fact that we are in a very bad position to identify events policy responses and identify financing needs and instruments. The point being that if we do not have the initial ingredients of the data and the methodology to perform a climate physical risk assessment, then it's very difficult to actually allocate capital. So I'm going to just walk you, if you go to the next slide. Here is just to make an example of how data inconsistency can create issues. And these are just two examples from financial literature that try to investigate the question whether equity markets price physical risk. And we see three studies, and two of them using even the same data, and leading to different conclusions. The first study finds out that heat stress is the most relevant physical risk, while risks such as tropical cyclone don't really matter. At the same time, the second study used the same data and find an opposite conclusion for heat stress and a positive premium for tropical cyclones. And the third study, this time using slightly different data, finds out that floods matter. So all of these studies show very different conclusions. And one of the key issues is once again data limitation. So even when the first two studies use the same data, the fact that there is lack of transparency makes it very difficult to understand the underlying assumption and hence to understand the results. At the same time, we know that there's different scores, physical risk assessments in the market, but still there's a lot of inconsistency across them. And lastly, we have a problem with the usage of past data. If we go to the next slide, we can see how we propose an innovative methodology to assess climate physical risk, starting from the asset level and going to the portfolio level, in order to overcome these issues. So the first point is, of course, we need to focus on the data and try to get a complete picture of the assets, the physical plants of a company. And subsequently, we need to understand the physical risk at those locations. So this implies the usage of probabilistic plant level climate risk assessment in the case what you're looking at today for tropical cyclones, but the same methodology can be easily extended, for example, to floods. Of course, at the same time, we need to assess the chronic risk, and to do so, we can use macroeconomic models, which enable us to understand the impact of physical risk on company business life. Lastly, we need a methodology to aggregate this information to the company level and their security. And in this case, we do it, since you're working on equity in the context of, you do it using a climate dividend discount model. And lastly, we look at what the results are at the portfolio level. So how does this lead to losses or even maybe gains for some at the portfolio level? And we try to understand what is the underestimation of climate risk that we currently have because we are neglecting the information instead. What is the key? If we go to the next slide, next one, again, we can skip this one. But this is just to give you an idea of the different components of the methodology to a deep dive. And the first one is, okay, we do have information on assets, somehow we managed to get it, we managed to connect it to companies and so on. So how do we assess the physical risk impact at a given location? And the idea is to perform an asset level probabilistic risk assessment, and essentially to match geolocalized assets, of which we know the location, the value, the ownership, to match it to information on hazard. In this case, tropical cyclone can come from Kalimata, in order to understand the direct damages from the acute risk, which can be computed a different way. We can both compute the term periods, so let's say a tail risk, and we can also compute averages. If we go to the next slide, we can see an example of the country of Mexico, and these represent the historical data for tropical cyclones, and we can already see from this picture the importance of going to the asset level. Because if we think that an asset is located, for example, in this point, like at the very center of the country, we can already see here the tropical cyclone risk maybe matters, but not that much for that asset. At the same time, if an asset is located where we do have a lot of landfalls, there is where we really need to take care that this risk is addressed. And if we go to the next slide, we can see mathematically how we can combine these facts with the asset information and ultimately get a damage, an idea of the damage that the asset suffers. And this is done using a so-called damage function, which links, in this case, the wind speed at the location to the damages to the assets. Importantly, we can look at these impacts in different ways. On the one hand, we can look at them in terms of averages, but it's also important to look at them in terms of tail events, and especially high return periods events, because those are the ones that will lead to the highest damages and hence to the highest risk. If we get to the next slide, we can then see how these information and assets can be fed to a financial valuation model. So equation 2 is just to give you an idea of the kind of model we're working with. It's the standard equity valuation model, so it's a dividend discount model. And essentially you have 3 periods, a short term, a mid term, and a long term, that where you get the value of the firm by discounting its dividends. Essentially, in this framework, we work on the long run. So if we go to the next slide, we work on the growth rate of the company on the long run. The idea being, okay, these companies are going to be impacted by physical risk in their life. And there's, of course, a lot of uncertainty about the short run. And we try to focus on the long run and try to understand, okay, what will these assets damage lead to and what will the current risk lead to in terms of adjustment in value and in terms of reduction of company growth. And in this equation, I don't want to go into detail of the terms, but we can see that one aspect is chronic risk, so the trajectory of a business line of a company, and the other aspect is this delta, which comes from the idea of asset leverage. So the two components lead to a reduction in the long-run growth rate of the company and hence of the value. Importantly, we also need to know how much an asset or business line matters for the company overall. We also need to know the revenue share. And this is the weighted term that we have at the end of the equation. If we go to the next slide, we just want to quickly show an application of this framework. And specifically, we work on Mexico. Why do we work on Mexico? Because it's highly relevant for cascading economic and financial losses, and because it has on the one hand, high physical risk, and on the other hand, there's a lot of foreign direct investment and listed firms. We work on a sample of 177 firms, which own 1,820 assets, which are invested in by European finance. If we technically, to additional notes, we carried out the adjusted financial valuation of the year 2020, and we compute the financial risk metrics, so portfolio VAR, at using a bootstrap. If we go to the next slide, we first of all look at the asset level. So now we build some results from the ground up. The first one is asset level, and the question is, first of all, the distribution of assets, as you can see on the top left, is highly heterogeneous in the country. So once again, saying just that the company is located in Mexico is not enough. We need to go to a lower level. The second point is, remember the distinction that we made between average and tail. And actually, the average risk is quite low. If you look at the top right, it's all gray. So one could say, well, in average, these tropical cycles don't really matter. But on the other hand, when we go to a return period, so we consider a tail risk, then we can see that both for 100 years return period and 250 years return period, we start to see hotspots of risk which are significant. And for example, in the 250 case, you can see there's a lot of red area on the western coast of Mexico. So that area is actually highly impacted by cyclones. At the same time, the center of the country, as we were saying before, stays unimpacted. So as an investor, I want to know whether the company I'm investing in is exposed to the west area or the central. If we go to the next slide, we see what this means for a company. And essentially, as we were mentioning before, acute risk are not the only ones that play, we also combine chronic risk. And the question is, how does these two combine together? Essentially, they both contribute to the overall physical risk on a company. And we can see that we can reach a high level of physical risk through different combinations. So there could be companies that are highly exposed on their asset, or there could be companies that are exposed because of their business lines. And these two can both lead to severe physical risk, which ultimately makes the task of an investor more complex. If we go to the next slide, we can see once again the importance of the distinction between the average and tail aspect of physical risk. And on this chart, we show the equity valuation on the computed using the average and the equity valuation computed using the tail risk. And the message is that the black line we see is the one where the two are equal. So the loss using an average is equal to the loss using tail. And of course, the important point is that none of those points under none scenario are on the line. They are all below it. Meaning that actually it is the tail risk what you have to be most interested in, what you have to be most careful about, because this is where the higher losses come from. And if we ignore it, we will see shortly, then we get severe underestimation of it. If we go to the next slide, we can see, next, maybe skip this one, more about technical assumption. We can see these points on underestimation of losses. The point being then, when we compare the loss computed using the different components, we observe that neglecting some of those components leads to important ones. And the first thing is, if we are an investor and we consider only chronic risk and we neglect tail acute risk, then we find ourselves on an estimation of approximately 70 to 80% of portfolio risk. Now, this is high, just because we are neglecting the tail risk that we're looking at, where the companies are located, and where the hurricanes come. On the other hand, it's even worse if instead of considering the tail component of acute risk, we consider the average. Because you can see on the bottom row, if we consider the average, we're actually missing essentially all of it, which once again highlights the importance of considering return period when doing this kind of analysis. If we go to the next slide, we see one before. Exactly. We see once again the importance of using granular data. And the idea now is, okay, we've been talking a lot about asset level data. We've been talking a lot about the need to go at the level where the company exactly owns their plans. And the question becomes, but there's a quite widely huge practice in financial analysis to just say, okay, this company is in Mexico, this company is in the US. I can use financial risk, I can use climate risk for Mexico, I can use climate risk for the US. And the question here is that good practice? And the answer is likely not. Because what we see is that when we construct a proxy like that and compare it to the actual asset level risk, we once again see significant underestimation. So you can see that we neglect the asset level data at the bottom line, and we consider both chronic and acute risk, the underestimation of the risk goes between 60 and 70%. So we are losing an important chunk of portfolio risk when we neglect the fact that we need to go at the asset level. And with this, I would go to the next slide and leave just a couple of conclusions and policy implications of why does this matter. So the conclusion from the more methodological parts are the ones you see on this slide. So of course, we introduce a science-based methodology to go from the asset level physical risk to the portfolio level risk. And this leverages, of course, a huge database model and then a climate dividend discount model for the component of financial valuation. The two important insights that I think are important to take away from this presentation are the two you see here. So on the one hand, if we neglect the data component, this can lead to up to 97% of underestimation of risk. The second one being that if we neglect asset level data, then this can lead to 70% of underestimation of risk. And thus, considering that tail risk and asset level info is crucial for climate finance management and then to inform adaptation finance. So who does this matter for in terms of action? On the one hand, it matters for policymakers because it is important to know where the risk is in order to inform decision. And this fits, for example, in the EU climate adaptation strategy, which calls for better assessment. On the other hand, it matters for investors because investors have been asked by their supervisor and regulators to disclose climate physical risk, to assess them, and they do need methodologies which enable them to do so. And lastly, it matters for companies because companies themselves need to report their climate risk metrics, for example, in the context of the CSRD. And these methodologies would enable them to meet their regulatory obligation and ultimately reaching a better disclosure framework and better data availability in the market, which would benefit adaptation finance overall. And with this, I would thank you very much for your attention and give it to the panel.
Maybe before moving to the panel, if you have any question for Giacomo, so we can have a few minutes. So if there are any questions either from here or online.
So, and people online, if someone has a question for further clarification, please unmute yourself and you can ask a question.
Yes, good morning. If I may, I don't know, I just unmuted myself, so I apologize. Someone else wanted to go first, but maybe just quickly. So Marie Scholler from EOPA, because we have been as a supervisor looking more at the transition risk on the asset side for the moment. So that really was the focus. And I think really, I really enjoyed your presentation a lot because I think there wasn't much focus yet on the physical risk. And from the insurance perspective, I mean, from a transition risk side, the risk was still assessed to, I mean, we had the premises and of course there are data gaps and so on, but maybe not for the insurance side to be that important. I mean, would you have an idea from a physical risk what this would mean in comparison with the transition risk, the materiality for investors like insurers? Do you have any insights there, or you can share something?
Yeah, this is a very good question. I think what we found also looking at the literature is that insurers tend to be better prepared than other investors when it comes to physical risk, for example, because they have sophisticated catastrophe risk model and a lot of analysis that was done in the past. So in this sense, this methodology is probably more useful ultimately for other investors which are less sophisticated and less used to the physical risk analysis. And on the other end, one can also say that insurers can also, positively contribute to, improving this kind of assessment, and they have a lot to contribute to the decision-making process by sharing their experience, actually.
Yeah, I mean, I think you're raising a good point, and I mean, I have worked in the insurance sector myself, and I agree that they would have better models that they use also for their underwriting side. I'm not sure to what extent it is yet today common practice to use it also on the investment side, but I think you're maybe more than definitely banks and so on, because they are closer to catastrophe risks in general. But it's a very good point you're raising, and would be nice to have more discussion on that, definitely. Thank you.
Yeah, thank you very much, Giacomo. Great presentation. I think I really like your assessment. I really like your methodology as well. I think there's a lot where we can also learn from, I think, and apply this as well. I was just wondering, so I'm Nico Jones, I'm from the World Bank side, and we often work in, let's say, more data scarce environments as well. It's like it's often not that we don't have the data at hand specifically on the asset level. So I'm just wondering, if you have any recommendations what to do, basically, if you don't have the asset level, which I understand is a crucial component here and a crucial part, except for just like closing data gaps, which maybe might be a longer term endeavor. And how, like, is there some proxy or something in between you could also use for getting to this in between, like, so basically to assessing kind of firm level, asset level like information while still not having this granularity of data available?
This is actually an excellent question, and we are currently investigating it, to be completely honest. So we are trying to assess whether sector-level proxies or more disaggregated geographical proxies could work. This is something we are working on, so I can't give you final conclusion.
But I mean, in the context of, I'm a co-author of the papers. So we choose also to focus on Mexico because it's, I mean, we're talking about Central America, and so meaning that the data sources that we found, I mean, can also return information for other emerging market economies. So this is already important. Of course, for least developed countries, this could be much more challenging, but the approach here is all based, I mean, the first big chunk of the work was really to develop a database model, being able to collect information which is already available from different type of data providers, and that we usually do or use for economic or finance analysis, and standardize and make this information connect the climate, business, and finance information in a coherent way. So for emerging market economies, this is already applicable and should be less of an issue. Of course, for less and least developed countries, this could be more challenging. But I mean, doing this exercise on more emerging market economies could also, I mean, from the comparison, we could understand and get some insights about how to develop more, less sophisticated and more aggregate indicators or variables.
Thank you for the presentation, and I very much agree with you what your answer was, saying that this assessment matrix is very relevant for reporting or disclosures requirements. So as you already know, all these regulations also are based on double materiality principles. So companies are required to disclose not only risk but also the impact side of let's say sustainability. So my question is, are you also going to look into impact assessment in climate risk assessment questions, components when considering these disclosures? Are you also going to look into the assessment, because now we are to the management, because now we are talking about assessment. So that's the first question. The second question, are you also give us next steps? So I don't know, your study going also to look into impact.
So
Can you here online?
okay.
Just to repeat the question when before answering.
Okay, yeah. So the first question about this is essentially management of climate risk, and this is a question that we are actually looking into. The point, so technically, one can consider adaptation measures in the damage function, and essentially can either tailor the damage function to different types of assets, or can consider adaptation which reduce the damage threshold. Now, the key problem in doing this is once again data availability on a different level. The point being that calibrating damage function tends to be very difficult and rely on historical data on disasters, which we do have, for example, at the country level or maybe at the national level, but we really lack at the granularity. We would need to say, okay, mines in Mexico tend to be highly exposed to hurricanes or less exposed to hurricanes at power plants, right? And this was actually shown quite well by a paper who performed an assessment of the CDP reports from many companies, and just found out that the adaptation measures are extremely scarce and very badly reported on. So we are working on it, but this is once again another gap that needs to be overcome in order to improve the assessment. For the second question, so if you got it right, it was about the impact.
Yeah, assessment of impacts.
Okay, so the impact of companies on.
Yeah, the impact of climate complaints. So the impact of companies on climate change.
The impact of companies about
If you're emissions related, so that will be
But
really mitigation.
That's mostly transition risk, so we are focusing on physical risk.
But we would have adaptation, but mitigation is not a part of.
Okay, thanks a lot for the interesting presentation. First of all, I like a lot the work, and I like a lot the slide that was showing a disagreement in the literature, most likely based on the fact that there is disagreement in the different data sources, but also inside the same data source, you find different results sometimes. So two questions, actually. The first is, how do you explain that papers that use exactly the same data sources end up with completely different results, if you investigated a bit what is happening there? And second question, how do you decide then what to trust more in terms of data sources, especially comparing data sources with similar level of granularity? Is there any project, especially in the academic community, to compare these data sources and try to get what is best quality for assessment?
Okay, so the first question is about one of the slides about the comparison of risk pricing results and the disagreement between two studies using the same data source. So there are some slight other differences in the methodology, but how exactly the results are obtained and how they are explained, I must say, I've raised a question actually for the authors of another paper to try to replicate both studies and try to find out where the different lays and where it's come from. So these, unfortunately, I don't have much details at the moment. For the second question is, how do you kind of navigate the scene of data? That's a good question.
Well, maybe we can say that at the beginning, so the starting point of this project was really trying to understand what information was already available, for instance, from standard data providers that we use for financial economic analysis. You can name the main ones, like S&P, Bloomberg, and so on, and to review the databases that were available. So we have in the appendix and the methodological part of the paper, where the paper is published online, and we can provide you the full list of data sources that with information about what you can find in each data provider.
I guess we had a similar experience at the European Central Bank at the beginning. When we started working in the first round of stress tests, we were investigating the different data sources available. And the main issue there is how do you answer the question, what do we use then, since there are a lot of different. So it's difficult to say what is best if you compare what's around. And from a central banking perspective, we don't have the resources and the mandate to work on improving these data sets or investigating them in detail. So at the end, we pick what we think is the best based on granularity, on the explanation of the methodology, documentation, and so on. But yeah, maybe it's an open question for the future is really try to understand what are the differences, what are the sources, and what can be considered standard in the academic and central banking community for this assessment.
Yeah, that's for sure. The standard is, however, I mean, we started from the data and methodologies that were published, and a lot of them, even for private data providers, they are not available. Even in particular, the scores that are much used for physical risk assessment, I mean, these are aggregated, and you cannot really disentangle. I mean, they tell you, okay, we calculate it at asset level. How do you then translate the shocks on the assets from different type of hazards? I mean, that's important. And also, we prefer not to go on the use of the scores, because using scores means it's okay for asset pricing, but here we do something very different. So that's also.
And then we offer paper aim and authors for 2022 is like, let's get physical, and that compares some of the metrics, and it's the one which shows the disagreement, but there you also have maybe some insights on how to compare them. But again, I said most of them are unavailable at the moment, so it's very difficult to even say what exactly they do. Okay. I think
Maybe a question. I'm Michael from the European Investment Bank. I'm very interested in this, what this type of research would say about the vulnerabilities of certain supply chains, international supply chains. Country like Mexico is probably very strongly integrated with the US economy and indeed others around. Can you say something from the work that you're doing about sort of particularly vulnerable types of supply chains, what industries might be affected, for example, based on the location, what some of the international consequences might be for highly export-dependent developing countries and emerging economies?
Okay, so for now we focus mostly on the investor side and less on the kind of supply chain industry side. To be said, the assets that we were interested in this paper are power assets, so like hydropower plants and solar power plants, but some of them are also in the mining sector and the energy exporters like energy terminal. So, and we see actually, if we disaggregate, there's quite some impact, for example, on the mining sector. So that is a lead that can be developed to understand where those mines lead to, if it's the US, if it's Europe, and then to kind of assess supply chain risk from that to the European industry, for example. Though at the moment, this is something we haven't done yet, and we are trying to understand more in European investors, but that's an important next step. Okay. More questions?
We will start with the first panel.
I'm sorry to bother you. Can you please keep your voices a little bit higher, please, or else the people online will not be able to hear properly.
Yeah, it may be difficult, especially when questions come from the room.
There is a microphone there. So
Yes.
the audience can
Okay. But yeah, if you can speak up to that, so the camera is there and the speaker.
Perfect.
Thank you so much. I'm sorry.
So my name is Irene Monastarolo. I'm a professor of climate finance at Utrecht University, and I'm very happy to introduce the panel today. So we have a mixed panel in presence and online. So starting from in presence, we have Martina Spiaggiari, which is team lead of financial stability at the European Central Bank. We have Nepomuk Dumsu, who is a financial sector economist at the World Bank. And online with us, we have Maria Schöder from, which is senior finance expert at EIOPA. And we should have also, Aya, are you with us? Yeah, the fourth speaker.
Yeah.
Maja. And Maja Ngabo from the G24.
Yes, please.
She's director. So Yabo Masha, she is director at the G24. Thank you so much for being with us today. So we will have a first 7 minutes each reaction to what we just heard, and in particular, since we are so lucky to have panelists who represent different international financial institutions who are working on climate and for which climate risk, for whose mandate climate risk matter, we would like to hear from you in a short first 7 minute pitch your reaction. So we can start in the same order from Martina and go up to Masha.
Sure. Okay, as I mentioned before, it was a great work. Thanks a lot for the presentation. And it was nice to see that it's indeed so important to use granular data and granular models. This is something that we have tried to do from the beginning when exploring the world of climate risk, also the European Central Bank. Second dimension that I like a lot is this comparison between average risk and daily risk. It's something that really changes the results of assessment. And again, this is something that we experienced ourselves So looking first of all at the data granularity. So we discussed that there are a lot of data limitations around. It's very difficult to compare what's available in terms of external data providers. We have the same experience at the ECB. You mentioned some sources like 427. That's one of the main data sources that we use in our climate risk assessment, in our climate stress test. At the beginning, we compared this with also with the JRC data, the European Commission JRC data, which is a bit more aggregating, trying to understand where the differences are coming from. But when you work at different level of granularity, it's already a challenge, and it's very difficult to find some answers. Sometimes there is consistency, in most of the cases there is not. So you simply have to make a choice based on the data that you use. And this is for the climate work. But then when we go to assess also the financial stability perspective, the financial institution perspective, we use a lot of granular data on the exposures. And on this, for example, at the European Central Bank, we are in a very privileged position because we have this credit register, the securities register that allow us to understand in very good detail what's happening in the bank's balance sheet, depending on their granular exposure to the counterparties. So another challenge that I will mention in this direction is then to merge this different world of data, the financial data with the climate data, on top of selecting the right data sources and how to aggregate them to make them talk to each other, let's say. Then in terms of data granularity, I think it was not explicitly covered in the presentation, but when we do physical risk assessment, we need to look at the future. And for that, we need the scenarios, climate scenarios, like for example, the one of the GFS, these are the scenarios that we use at the ECB. And also there, what we see lacking a bit is this granularity in the future, because we have a country aggregates of dynamics for the future, but we don't have very granular sectoral data, for example, that would be, you know, in my view, the minimum requirement to do transition and also physical risk assessment. In terms of models as well, of course, having granular data requires also having granular models to process them. And this is not trivial in the sense that the standard stress tests that usually the central banks run are based on more aggregated data, actually. So bank level information on the portfolios and so on. So when entering the dimension of climate work, it's super important also to translate this granularity in the modeling framework. This means that we need completely new models to be able to capture the climate risk driver and how they transmit at very granular level to the bank's balance sheet. So it's very good to have some work that proves that the asset level dimension is important, because it proves also the value of this effort of basically recreating the risk assessment framework in the stress test into the climate stress test, for example. And finally, looking again at the exercises that we have done, for example, at the ECB on climate stress testing, and the main results for us are, first, that the short-term costs of the transition are always more than compensated by the long-term benefits in terms of reduction of physical risk, but more importantly, that the risks are really concentrated in the tails of the distribution. So if we look at average, we see only a moderate increase in losses over time and the risk over time, but it's in the tail that we really spot the issue, and this is perfectly in line with what you have also do with your work. So I don't know if I have a bit more time for it.
Yeah, so you have other 4 minutes of this.
Then you were absolutely effective. I basically mentioned similarities and also main findings and methodologies behind our first climate stress test exercise, but at the ECB, we have recently published also a second climate stress test, I think 2 weeks ago, more or less. There we focus more on transition risk, actually, because it's now very clear that we have to transition, so we need to understand how to get there, what's the optimal way, and what's the optimal transition pathway, investment process that will lead us there. But we have included also a couple of elements that I think are quite relevant for this conversation. So first of all, supply chain dynamics. This is something that before we didn't have in the climate stress test framework. Now we included this at quite aggregate level, in the sense that we look at how country sectoral GBA shocks generated by the transition process, actually something similar to be done for physical risk, transmit to the other country sectors. So we have these upstream and downstream GBA shocks that move from one country sector to another in order to have dispersed effect of contagion, at least at the macro level. And then I really believe we should go more granular. You showed that it's very important to do that. You mentioned also the supply chain dynamics. We should really go more granular to understand what's happening in the interactions between firms. Because probably with this macro variable, we're capturing 5–10% of what is actually happening if we look at granular dynamics. It's not important to understand only the connection between the sectors, but also the role the specific firms play in the network, because some big firms can have a very, very adverse impact on the others. And then we explore here, again, the physical risk work, but a lot of granularity is also important in exploring the transition dynamics to get there. And this is actually the second new component that we have in the stress test. When assessing the transition, we don't rely anymore only on emissions, but now we also take an energy perspective. I'm trying to understand the energy mix of the different companies at a very granular level, because we have observed over the past year how this matters in terms of energy prices, how they impact the energy expenses of the firm and this transition process. And in general, I think that keeping this transition and physical risk dimension combined, it's very helpful, because it really triggers the transition process. Try to understand the trade-off between these efforts and the benefit we will get in the future. So in this I conclude.
Yeah, that's really interesting indeed. The last point, maybe if I can just add a word, I mean, on the transition risk side, it has been like 10 years that we have been stressing you really need to go beyond emissions and consider the energy technology profile of companies, because this is what matters much more than beyond the aggregate confusion of emissions information and misreporting, but really what gives you an idea of how well a company is positioned in order to face the transition. So now I would like to pass the word to Nepo. Nepo, you work a lot on financial stability in particular for emerging markets and developing countries. So if you want to see,
Yes.
add your perspective.
Yes, so thank you very much, first of all, for inviting me here, for being here today, and great presentation so far. Also great to hear always what ECB is doing, which is also like always a little bit, let's say, in our context, something, seeing what you could do if you have like great data available, which is a little bit something we often lack in this context. And I think it's something which is maybe also my starting point. So just to give you a bit of background, so I'm in the financial sector department of the World Bank, where we focus on financial stability in our unit now since a few years, also more on climate, a little bit also increasing now on nature. So this is something, these are the new topics disregarded that are evolving. And my unit, the unit I'm in, we're also like jointly doing with the IMF, the FSAPs, financial sector assessment programs, where also like the climate topic is now increasingly picked up. And I think in the latest batch of FSAPs, almost every FSAP actually now has a climate component in there as well, where we do like climate assessment. And if I say climate risk assessment or like climate assessment and risk assessment, what I mean is also like a broad, let's say, broader approach that we usually use forward there, or like we use going forward there, which ranges from what we call like an exposure analysis, which is a little bit similar to what Giacomo presented at the beginning, just getting understanding what does the financial sector look like, where's the sectoral exposure versus geographic exposure if you have this information available, but then also getting an understanding of the different disaster perils that might actually be relevant in this country context, understanding of course the transition risk side, and in our context specifically of the FSAPs, we usually also like include an assessment or benchmarking of what are the current approaches that the supervisors, central banks in countries are usually taking in this direction already. So what are the actions they do with respect to risk management, what are the climate risk assessments, etc. And for us, this has been proven like really, really useful, especially in the context where we are often starting very early on in the game, so to say, still in many countries. I mean, a lot of countries actually also now doing quite a bit. We're actually active in 46 countries at the moment. So it's really like kind of something where you see there's a lot of demand, there's a lot of interest in this topic, but with very different stages, I would say, and levels in the process of doing this. And so in this case, what this exposure analysis usually help us to get to, and it's I think links to Giacomo's presentation, is like really understand where are the data gaps, because sometimes really like we have financial data specifically, which is on NACE 1 level or NACE 2-digit level at maximum, which is then of course very difficult to move forward to do like this stress test assessment, specifically focusing on the tails, specifically focusing on the more detailed asset level information. This is something we're like just getting this understanding, and then from there seeing what is possible, what is feasible to work with is already quite useful. Usually then try to combine this also like with a strategy, like in conversation, of course, with our client countries to see how can we close those data gaps moving forward, and also then to see what we can do with respect to climate risk assessment. And I think there we followed a bit more the standard approach, which I would say by now is a bit the standard approach, which I think you also looked into. So you try to develop scenarios, physical scenarios, transition scenarios. Physical scenarios are often based what we have our disaster risk financing team, which is very well suited in the disaster risk assessment, and they look into catastrophe models, which are often, of course, based on historical data, but then also see how can this be enhanced, how this can it be like done, become more forward-looking moving forward. So this is a little bit the approach we follow on the scenario side, and then macro, we usually follow the macro assessment path, where we have some in-house models at the World Bank that are used to this context. At the same time, we're also currently trying to enhance and develop further this macro suite of models we have. So we have several projects actually trying to get more of these nonlinearities into the models, which are often not there yet. Also trying to increase the sectoral granularity. Geographical granularity is a big issue actually, and here's like this problem as well. Like, what kind of country are you talking about? If you're talking about a very small country, maybe like Rwanda, if I give this example of something, then one disaster impact might already be macro relevant, so to say. If you're working in a bigger country like China or India, then like one disaster impact might be as relevant. So then, of course, the question is, how do you bring this to the macro level? You might also need some subnational data. So this is something where I think this is like where our thinking circuits around, where we also like try to develop and make progress in this direction. And then the final step is usually working on the financial risk assessment. And there we actually often work very much with the models we have at hand from the counterparts, like from the central banks, from the supervisors, because they of course have way more expertise and detailed knowledge and data outlets than we have in the direct application for the country context. I think this is something which also matters a lot, I think, and yeah, being very contextual, just approach as much as possible. And I have more time, or just
Yes, you still have 4 minutes.
Okay, 4 minutes.
Yeah, you have
I'm speaking to quick into the
extremely effective.
That's great. I think, yeah, one thing that I might also want to emphasize maybe in this context here as well, like also the question that often comes up, actually, what do you do afterwards? Like, what are these risk assessments for as well, right? Which I think also is an important question. I think from our experience, and at the early stages, it's usually like a very useful information tool, awareness raising tool as well, like for the financial sector, because that's, I mean, specifically if the analysis is rather high level and not as granular as you might want to be, then it's definitely at this stage mostly like information awareness raising tool, without further supervisory guidance or supervisory action on this. But this, of course, is also like some step you might want to get to eventually. And again, here is also like often a parallel approach that you can work with. In general, we try to bring all of these climate risk assessment, not having it in isolation from our approach, but bringing it into what we call greening the financial system, like a bigger approach, which contains not only my team, the team, but also like our so-called long-term finance team, and the disaster risk financing team, which are more working on this opportunity side, which what we call opportunity side, because of course another mitigation, but also adaptation. There's a lot which we could do, and with scaling up investments, mobilizing private investment, as you might have heard, those like increasingly bigger priority also like now for the World Bank. And I think this is something where like we also try to embed this. It's like the climate risk assessment is one part of a bigger toolkit, as we call it. We have this toolkit for policymakers for greening the financial system, where you basically work on different levels. So one is like strategy, for instance, just like trying to get the different financial actors in a country, like the central banks, the supervisors, regulators, together and allow them to develop basically a strategy, a coherent strategy. Also, for instance, creating platforms, interagency platforms, so they can coordinate, which is also an important topic, giving this broad and overarching nature of climate change, I think. Other important aspects are really like also increasing transparency. So there's a lot of work we do on the disclosure side, developing green taxonomies, etc., which also like are part of this overall system. And again, Giacomo also raised this. These things all feed basically in ultimately as well, ideally, for getting better data and better climate risk assessment ultimately. And of course, there's also like climate risk assessment component, where we also like work with different entities together, so the central banks again, but also supervisors have a big role to play in this regard. This is something which we see. Finally, I think the point is also then really like creating financial instruments around this as well. This could be like really like adaptation finance investments that we of course been trying to scale up quite a bit. Our disaster risk financing team has a lot of experience in disaster risk finance, but then also of course trying to make this climate ready even more, assuming that the frequency intensity might change of the historical observed events. And of course also from on the mitigation side, there's a lot of interesting developments, I think, on the sovereign side, where you have like these the traditional, I would say, already now green bonds, but of course also more sustainability-linked bonds, where Uruguay and Chile have been interesting examples that issued those in the last couple of years, having like that step up and step down components for achieving certain targets, climate targets, energy mix targets, I think in the case. And these are like also some developments where we actively contribute with our team. Again, trying to bring and to think those things together once we engage with the companies. Yeah, I guess I stop here for now, and I'm happy to.
Thank you so much. It was a very comprehensive overview, both from the EU and SRU side. So, and now invite to join us Marie Scholler. Marie, could you bring your experience from EIOPA? So EIOPA is the European Insurance and Occupational Pension Authority, so it's the European regulator for insurance and pension.
Yes, no, sure. And can you hear me properly? I hope the sound is good. So indeed, I think from my end, and as I'm working for EIOPA, so we are the European Insurance Authority, I will mainly focus on this aspect of the insurance sector and also the impact of climate change. So that's a bit to give the background. We all know, well, insurance companies, they're very important for the financial stability. They are large investors. There is this growing link between insurers, banks, and also, of course, I think very key, insurers, they are safeguarding the financial stability by insuring houses, firms against natural catastrophe. And that, of course, also is one of our clear focus at EIOPA, is also to look really the impact of growing physical risk on the liability side. And insurers, I would say, they are really in this situation where climate change will impact both assets and liabilities. So we as supervisors, we really need to understand climate change risks. If we just think of insurers looking at natural catastrophes, more severe, more frequent event will impact the asset side, and also very importantly for the insurers, the liability side. For example, claims would rise more than what has been expected by insurers, and then there is of course a problem for the insurers. Maybe they will also become insolvent. So we as supervisors, we are very concerned about that. And what we also of course very concerned about is the fact that insurance is likely to become more expensive and sometimes even unavailable in high risk areas in the world, and this is going to increase also the existing insurance protection gap, and this has also very negative effect on economic growth. So all in all, for us, this is very important. We are also working, for example, with the ECB to look at potential actions to improve the situation, increase the uptake and efficiency of catastrophe insurance. I think before we also already heard from the presentation, also on the asset side, physical risk have an impact. It's something we as EIOPA, we haven't been looking so much for the moment. We focus more on the transition risk, but I see that there is definitely the need to go more into that. Maybe before coming more to this point on data and models, just to reemphasize that we as EIOPA, we also see that insurers and reinsurance company, they have a key role to help to mitigate climate change risk. I think this is very important. Of course, they are impacted by this risk, but they also have a role to actually help to mitigate these risks. And just to give you an example, I mean, they can help to make the society and the economy more climate resilient. We heard before, insurers, they are used to use catastrophe models. They have over the years collected a lot of data. They have and a lot of experience to manage these risks. So we really think that they have a role here to play proactively to help people to manage this type of risks. They can develop new type of insurance products that incentivize us to take more adaptation measures. We can think, for example, that they could, lower the premium, so the cost of the insurance product, if a policyholder, if we would then take adaptation measures, because this would be risk-based. And so, I mean, this is just to highlight also the fact that, okay, the insurance sector is very key and is impacted, but also has a role to address climate change risks. So with that, of course, we know that assessing the risk, climate change risk, is key. We need to know what we are talking about before we can retake then actions also to try to mitigate the risks, for example. And for that, data and models are extremely key, and at EIOPA we have recognized that since a while. What we have also seen that it's not always easy to get access to these tools and data. To give you an example, we have recently released an opinion to supervise the use of climate change scenarios by insurers. So we set expectations on the supervision of these climate change risk scenarios. And we know that this is not going to be an easy task, especially for small and mid-sized enterprise. It's usually not easy to find, okay, which tools, which data should I use? Sometimes you have models that are available, but they are quite expensive, so you need to license them. And then there are also other tools available open source, but there you might also need to really dig in the code and so on to be able to use that. So we have recognized that, and what we wanted to do in order to push for more model development and more awareness about catastrophe risks, for example, we took CLIMADA, so that was the catastrophe, the open source catastrophe model presented in the presentation before, and we have built a user interface. Because when we discussed more with small and mid-sized enterprise and also with European supervisors, it's really a knowledge that has to be built. And so not everyone is an expert on catastrophe risk modeling. So if you really take this open source tool, it might be too much. And we thought, okay, let's maybe, build a bridge between what is out there open source, but maybe not so user-friendly, and to make it easier for people to understand, okay, what type of input data do I need? We talked before about exposure data. We need more detailed exposure data and so on, so that really we kind of train the people to get used to doing more and more of this type of analysis. And here we simplify that. So it's available on our website. It's open source, so anybody who's interested could just download it and use the interface. It's just to simplify the use of CLIMADA, which would be maybe sometimes a bit, would require more work to really dig in the code. So that's an example, a clear, concrete project that we had, because we want to push for more development. We want to push for bringing the great stuff that is sometimes done at academic level and to bring it closer to day-to-day applications for more people to use and to raise awareness. And ultimately, we think that if we raise more awareness, more understanding, then also the input data will improve because more people will need them. And then, of course, this will also create a better database and so on. I think we as EIOPA, we have also used CLIMADA just to highlight this, also to assess, for example, the impact of future flood risk on the insurance sector. So we had collected European-wide data on the exposure data, and we have run that into CLIMADA, and we have the same issues as before. Of course, also when we collect data at European level, it's not always easy to get access to latitude, longitude data. So we also had to find some compromise and sometimes collect more regional data. But, this is a step-by-step process, and all in all, the idea is to improve the situation, to raise awareness, and hopefully to converge to better modeling. As a European supervisor, I think we recognize that there is a lot of work done by multiple stakeholders. The situation is improving. Sometimes it makes it harder for our stakeholders to also know, okay, which data, which tool should I use, because now there are many projects multiplying out there. We as supervisor, we also used to collect data from the insurance sector. And as I mentioned before, the insurance sector has a lot of data related to catastrophe risks. So they have collected also loss data over time. They have collected exposure data, so they know where are the different assets. And these are data we think are extremely valuable. And as supervisor, we would like to help to make that also more accessible. And so this is work we are going to start in the coming years, but we believe that we would like to improve the access of that type of risk for everyone, for the supervisors, of course, so that they can also better monitor and manage the risk for the insurance sector, but also for public entities or anyone that would be in need of this data. So there is more to come. It's going to be a long way, but we believe that by sharing more this data, by encouraging more open source modeling, bridging a bit this, making this bridge between what is out there, open source, and bringing it to day-to-day business need. Hopefully we can make a contribution and improve the situation.
No, thank you. This is for sure an important starting point. Still, I mean, it's very important to have open source models and data. On the one hand, however, there are some challenges that should not be really understated. I mean, we also use Climada, and we had really to work a lot to find some issues. Then there is still an issue of coverage in terms of disasters, because you can cover floods, tropical cyclones, but for Europe, of course, this is much less relevant still, I mean, on the tropical cyclone part. And on data, what we found working at the paper is that, yeah, it's important to have geolocalization, but it's not the end of the story. You need to combine climate and not climate information in a coherent way. So it's still, let's say, it will be a long process, and we have little time. So that's a lot of work. So thank you for bringing your experience. And Marcia Yabo, we are so happy to have you here with us. Marcia is director at the G24, and we know that G24 climate represents a major challenge, and we hope also could represent an opportunity for action for G24 countries. So Marcia, could you bring your experience?
Thank you very much. So at G24, obviously our focus is on how general policies affect our member countries at the macro level. The presentation we've heard today is very informative, because the better information we have at the micro level, at the granular level, the better that some of the policies that we articulate at the macro level will be. If I look at using the issue of some of the physical risks from, climate change as an example, say something like flood, or some of the environmental issues that our member countries are facing. What we see there is a marked impact on the overall economy, on the financial stability of countries, and also the fiscal sustainability. So if we're looking at the overall economic impact, one is, say, the case of Pakistan, the big flood that happened in Pakistan last year. We're talking of substantial loss of investment. We're talking of substantial unemployment due to loss of productivity, loss of farmlands, loss of factories, and that also feeds into wages. So the aggregate impact is really lower GDP, which then feeds into the country's financial stability and fiscal stability issues. We'll also find out that in some of these cases, the impact on government expenditure, when we move to the more specific fiscal impact, is that public finances are stressed, major decline in public fiscal revenues that governments use to not only for the mitigation of the specific risk or the specific occurrence, but also for taking the future plans, the future fiscal program that the government is going into. The other fiscal impact you see is how such challenge affects the government's borrowing in the international market. Decline in GDP, decline in the revenue, all make a country a more risky borrower. And so in many cases, you see some sovereign bond spread when this kind of challenges occur. And so being in a position to pay higher interest on debt also feeds into some kind of debt unsustainability for many of our countries. One of the challenges we've also seen in countries that are maybe more dependent on the external sector, like tourism or those kind of businesses, the impact on their public finances is profound. Now, moving to the impact on the financial sector. In general, this kind of data that has been articulated in this presentation, even though I must confess that because of poor audio quality, I couldn't follow very, very closely. But based on the information coming from the general conclusion, I think what is clear is that the balance sheet of the banking system, the kind of losses that we're likely to see in the banking system from extreme weather conditions could actually be magnified. But without the kind of granular data that has been shown in this presentation, that information may not come out clearly. So that speaks to the importance of having this kind of models that are able to tease out some of the more profound risks. The impact of some of the developments in the insurance sector, again, looking at the US example, more recently, in the past few months, where in Florida, there's been insurance companies are declining. They don't want to insure because the risk of getting into adverse kind of insurance environment is becoming more and more difficult for them and unpredictable for their balance sheet. So they are not in a position to take a more forward-looking approach on what is likely to be the case because these weather conditions are becoming more and more unpredictable. So those kind of decisions on the part of the corporate sector, the corporate financial sector, will then have implications for financial stability, especially if banks are not in a position to get the kind of information, data that they need to predict what will likely happen. The interest rates and how it affects how the cost of capital changes, maybe because the banks are also having to, the financial sector more generally is having to put on more resources to take care of some of the risks that they did not think would materialize is also something that could affect the overall balance sheet of the banks. And so we're talking of a situation where the overall financial stability of the system could be an issue, maybe because non-performing loans will be expanding, and there's those corporations that have high leverage are unable to meet their commitments. So in general, the countries that have experienced both this kind of physical risk and not so much the transitional, but the more physical risk, we see that in signs of instability in their financial system. Now, what is the recommendation? The issue is that there needs to be much more information on the data points, on the micro level interactions, but the unpredictability of the occurrence of some of these events, some of these climate events, just means that the mitigation, the how corporations stress their balance sheet, how they take some of these factors into consideration is what will be important going forward. How these risks would eventually be translated into an actual occurrence. So in general, I would say that for us that are looking at the issues more at the macro level, definitely a model that is based on granular farm level data is something that many countries will find very useful. Thank you.
Thank you so much, Masha, and thank you all the speakers for keeping the time. So we have still a few minutes for short reactions from the audience, either in the room or online. We can still take a couple of questions. Yeah.
Yes, my name is Maria Ruth. I'm the representative of the Spanish Agency for Development Cooperation here in Brussels, and also IC is the name of the Spanish agency. We are holding the presidency of JEPIC, Joint European Financiers for International Cooperation. We are together there with IFD, HDP, BTK, and KFW. My question is just about the possible private-public partnerships on building a little bit on what Masha was presenting on the insurance companies. They do have a lot of data, yeah? And very often in least developed countries and also in middle-income countries, there is a lack of this data by the state, because the state is not a proper functioning one, of course. So that's why we are helping them. I'm wondering if there could be room for some kind of private-public partnership on that. So the insurance companies give data in return of something. Just my question would be, what would be this something? And I just wanted to comment a little bit on Latin America and the Caribbean, because Mexico was presented here, Chile was also mentioned, and Central America. By the way, Mexico is a Northern America country. That's why they are on the NAFTA. They are not Central American one. But my comment is on the role that integration systems can play also in the whole setting we are talking about now. And I wanted to underline the very interesting experience by SICA. SICA is Sistema de Integración Centroamericano. I do not have to translate it, I hope. So the integration system in Central America. They do have a conference of ministers for risk reduction, and we from the Spanish cooperation have been helping them for a long time in institutional strengthening. So maybe that would be something to do with them at the European level. That's all. Thank you.
Thank you. So who wants to take the question on private-public partnership for insurance?
Yes.
Okay.
Sorry. Yeah, I think that was a bit raised to my points I made before. So indeed, I mean, what we clearly recognize as a European insurance supervisors is there is the need to work closer between public and private entities. I mean, you mentioned loss data. I think this is an excellent example. We as an authority, we also need this data. We have been working with, for example, reinsurers. They usually have this type of data, but they also recognize that they are high value data and that they could get also some money from this data. So they are not so keen on, just sharing them open source. So we have recognized all of this and we want to improve the situation because we know there are many people who are in need of this data. We talk about developing more models, more catastrophe models. Academics, if they want to develop these models, they need to calibrate these models and they usually use this type of historical loss data. Okay, with climate change, it might not be always ideal, but at least it's a starting point. So we want to improve the situation because we feel as a supervisor, I mean, we are already collecting a lot of data from the insurance sector, and we feel that we can have a role there. By saying that, you can imagine that this is going to be a long journey until we really reach this point that, okay, we collect the data and we can make them potentially available, open source. But this is a direction we want to take and where we will have definitely now in 23, 24, this is on our work plan and we will work toward improving the situation. You mentioned what, if it could be kind of, we get these data, we make them accessible and the insurance sector can get something in exchange. I think what you might already see in the European taxonomy for sustainable finance is that insurance are recognized as an economic activity that can contribute to climate change adaptation. And one criteria, because they have to fit a number of criteria, is actually that they make available insured losses, for example. So, they are kind of these type of elements that we could also push a bit further to work more. So, yeah.
Thank you. So we have still time for a short question. Any other questions, either from online or from here? From the room? Yeah.
I can ask one to the room. JP from the European Commission ECHO, so might explain my reason for the question too. And I know the session is on physical risk in assets and finances, but how important, maybe for the ECDPM World Bank, how important would you consider human cost in the modeling efforts too? I know it's a Pandora's box, and IPCC synthesis report says that it's vastly very difficult to assess human damages of any disaster, but it's usually, for example, in the Pakistan floods, it's non-counted in the post-disaster need assessment, and actually has feedback loops to finance and GDP losses and so on. But would like to just hear your views about that. And I know it's a Pandora's box, but coming from my background, it's quite pertinent for us, usually, the human cost of it.
Okay. So human costs are not directly included in the macroeconomic models, but somehow they enter, especially when we look in the long term of big changes that can happen to humanity due to climate change in terms of people, population, employment, and so on. This enters as part of other variables in the macroeconomic model. So I would say that to some extent we try to capture that, but again, we are in a very new field where we try to fill gap by gap and understand how also transmission channels that we currently don't account for could improve there. So I would say that currently there is a dimension, especially forward-looking, that takes that into account. We have population, employment, the need for resources to serve different sectors, for example, but definitely more is needed.
Yeah, maybe if I just add to this as well. I mean, I can just echo what you say, but maybe to add to this here is that often these kind of impacts are modeled then as chronic impacts, in these models. So like you usually have like a productivity effects or something which would say, okay, these come from human cause that so you have basically potential loss of skills or something which could feed into their productivity issues. And I mean, usually that's why I'm saying it's usually modeled still as a quality event where you say, okay, more heat waves, long higher temperatures in general reduce this, reduce the productivity. I think, to my knowledge, is so far less work still on the acute events and how they actually would, well, like how the human losses would impact the acute events. I mean, maybe someone in the room knows this better than I do, but I'm not too much aware of this one. And I think related to this, of course, as well, where we also have now some studies in this field, but again, I think the link to the macro models is not fully done yet. Is, for instance, with climate-induced migration patterns, which is also something I guess in this direction. And here also there are studies, I think specifically for Eastern Africa now, where there is quite some interesting work being done, also with climate attribution, for instance, how much this might have caused to some instability in some migration patterns emerging. But I think the complete link to the macro models via transmission channels, via damage functions, is at this point still very expensive.
Yeah, I would concur.
So, to stay in time, so I would thank you. I will thank all the speakers and the speaker and the panelists who joined us today. Thank you so much for the interesting discussion and also for the public for the questions. And we can close this. We can close the session. Thank you.
Yeah, we will have a coffee break now until 11:30. For people following online, we will be back at 11:30.
So we're back for the second part of this discussion, where we are turning to different actors to try to see how we can tackle the question of climate adaptation in a more effective manner. My name is Sandilar. Yeah, and I'm very pleased to be joined by David Turker, who is the new General Manager of the Association of European Development Finance Institutions, EDFI. And you were telling me this is the first time you are speaking in this capacity?
Yeah, this is the first time I'm being introduced like this. Yeah.
So thank you very much. You're already a familiar faces coming from more well known in the development finance community already. And I have the pleasure to be joined by Michael Mattinger, who is a Senior Climate Officer at the European Investment Bank, and he stepped in for Cynthia Lozano, who is unfortunately on sick leave and could not join us today. So thanks a lot, Michael, for stepping in. And online, we are joined by Christine Müller, who is from working at DG Climate and who should have been also with us today, but she's also ill and feeling unwell today, but kindly agreed to join us. So Christina, we will be able to speak. And we have also Jérôme Heinz, who is the chair of the Practitioners Network at Expertise France, who was also supposed to be with us, but is stuck in Paris, so could not, will join us online. So both of them will join us online. Let me just make a few introductory remarks, perhaps about this session and what is happening. And so don't worry, I have just slides, but it's just for pictures. Starts with the first one, please, Daniel, the next one. Yes, we did some looking at what are the European financial institutions doing and development banks, what are they doing in terms of climate adaptation? And in fact, we first we have to thank them because it's not always public information, so they all very kindly shared all the data and information about how much they are doing on climate. And so there are an element quite striking is the first one, and I'll start perhaps with the bottom row, is that both the EIB, EBRD, WIFD, the large public development banks, and the EDFIs, they are doing a lot on terms of climate finance. So climate finance is about half and sometimes up to 2/3, 1/3 for DFIs. But we see that the climate finance as really as part of their investment activities has become a very important element of what they're doing. Yet, when we look at how much they are doing in terms of climate adaptation as opposed to mitigation, and we know that mitigation is very important, and if we want to have the net zero targets, we have to definitely boost climate mitigation. But if we look at how much they're doing on climate adaptation, some, and even ERB Global, that's the for the activities outside the EU, 10%, EBRD 4%. The public development banks are doing better. About a third of the activities of climate adaptation, or a third of their activities on climate, targeting climate adaptation. But European DFIs first incomplete reporting, perhaps David, we can go back on that. But the level is still below 10% of the climate finance that is going to climate adaptation. So perhaps adjusting this. We wanted to start with this because that's what was triggering our concern about, well, it's very important for the well-being of people and for the future that we increase the resilience to climate change. And that is a very important dimension for government. So climate adaptation is really key. Next slide, please. So what we did is that was triggered some of the work we did in the context of CASCADES and trying to understand why the mobilization of development finance and climate adaptation. What are some of the bottlenecks? What are some of the efforts that are made, and what is successful or not? So I would strongly encourage you to look at some of the elements of the broader study that we did. And we have the next slide, please. And I just wanted to quickly highlight some of the recommendations. So one is that many institutions do not have a specific target in terms of what they want to do in terms of climate adaptation. So we were thinking, to set clear ambitions of what to do might be quite useful. But there's also, and that's the most important, perhaps we need to have more innovative type of approaches to climate adaptation. Might not be necessarily something easy to do. And that's the second challenge is that quite often there was limited cooperation and elements between the different actors to climate adaptation. And so in this context, it is good to try to think about partnerships and consider how it could be done better. I think some microphone might be open. We get some backgrounds. Please ensure that everybody has muted their microphone so we have good sound quality. And so there are also different adaptation finance approaches that can be taken, including risk mitigation and different type of blended finance that might be interesting, and that might also be warranting also some form of cooperation. And the last one, and now we won't dwell too much on that, but is to have proper risk assessment, and so we're discussing the risk assessment and to develop plan. Next slide. So this is just to give you, to whet your appetite to go into some of the more concrete recommendations and what we will discuss also today. But we were thinking, doing this work, that perhaps what's missing in the ecosystem, at least at the European level, is that we were asking, in particular, European development finance institutions and some of the actors to work on their own on climate adaptation. And perhaps there is some difficulties to work alone on climate adaptation. And that trying to think about how we could create synergies between the different actors, and including from including the DFIs, the public development banks, the donors agencies, and different tools, and combining them in a way might be able to unleash also quite a lot of the efforts on climate adaptation that otherwise done by themselves might be more difficult to do. So that's basically a question that I'm putting to the people of the panel today. And perhaps I will start with Jérôme Heinz, who has joined us online, who is from the who is chairing his presidency of the Practitioners Network, and coming from Expertise France, that is itself an actor. Part of the Expertise France is the technical implementing agencies of the AFD group, so Agence Française de Développement Group, together with Proparco and so perhaps there, Jérôme, you might have some good insights in terms of, how can cooperation stimulate climate adaptation, and what is the recipe? And by the way, AFD is doing, as a group, is doing very well in terms of climate adaptation. So perhaps there is some good lessons there. Jérôme?
Hopefully, thank you very much, San. Good morning, everyone. Sorry for not being here with you today, but I will try to do my best virtually in order to give you some insight from the Practitioners Network perspective. Maybe to say that I'm very pleased to be with you, and to remind you that the Practitioners Network was founded in 2007 and is a leading network of public development agencies composed of 24 members. The PN is one of the 3 European networks you mentioned on your slide dedicated to development issues, along with JEFIC for PDBs and EDFI for DFIs. By providing feedback on European international cooperation policies from a practitioner's perspective, the PN contributes to the coherence and complementarity of European development cooperation efforts. It encourages an integrated, pluralistic, innovative, programmatic and efficient, hopefully, approach in implementing European international cooperation program. As a platform for European technical cooperation, the PN aims to strengthen cooperation, links, and complementarity, creating opportunities for cooperation and synergies at the implementation level, of course, providing feedback from the how-to perspective. Our shared goal is really to collectively ensure that we implement effective European cooperation to accompany partner countries in their effort to achieve the SDGs. And in this regard, with a focus on climate change issues, we intend to exchange best practices on how to integrate or to take better into account climate change resilience in a cross-cutting manner in the concept, both in the design and the implementation of the project. The networks, all the members promote and pledges for stronger coordination, of course, between financial and technical cooperation, and especially DFIs. In order to work efficiently together and to boost resilience and adaptation, we must achieve systemic change, according to us, in a coordinated approach to contribute to the achievement of the SDGs. This means combining bottom-up and top-down approaches. Donors need to mainstream further climate change resilience within their cross-cutting and sectoral programmation, encouraging, therefore, implementing agencies to integrate this matter on a more cross-cutting manner, whereas implementing agencies as us, which are more connected to local on-the-ground best practices, have the opportunity to influence the design of programmation and financial instrument from experiences based on the feedback and the best practices to tackle more efficiently, climate change resilience. That means stronger coordination, of course, synergies between development actors, PDBs on one side, DFIs on the other side, and implementing agencies like the PN members that provide the technical assistance. For that, we need different things, I think, and according to the member of the PN, I would say that we need to identify impactful and sustainable bankable projects. Development cooperation agency have the capacity to work jointly with financial institutions to identify such projects, in particular to consider climate impact. We need also to strengthen the regulatory policy and business environment and the capacities of government institutions, both central and decentralized, It's very important for us to mention that an appropriate legal and policy frameworks must be in place with intense dialogue prior to launching investment to secure space for the expression and ultimately foster ownership by local actors. Development cooperation agencies have huge experience in providing technical assistance to support national authorities and to build such a system. Last year, maybe I would like to mention and to straighten on one of the PN study carried out by the European think tank group on enhancing coordination between European donors, development agency, and DFIs PDBs. The study drew insight from case studies on existing coordination efforts among donors, implementing agencies, and financial institutions for development. And what we could note on this study are different points I would like quickly to mention. Maybe that coordination allows for the management of not only financial risk, but also security, political, and reputational risk in case of unfortunate events and operation failures, which are more likely in regions vulnerable to climate change. The fact that donors, implementing agency, and DFI can put together their unique set of complementarity expertise and knowledge and their existing network in partner countries, both public sector actors, but also private sector actors, civil society, and relevant stakeholders. They should also work together to overcome asymmetry in objectives and incentives and misalignment of priorities, sectors, and thematic to unlock their full potential and to engage in the Team Europe and working better together approach, which is very crucial for the PN member as we are. Of course, the Team Europe, it seems for us very key in order to achieve concrete concrete achievements, excuse me. Maybe among these findings, I would like, and not to be too long, and of course being able to answer questions after the different panelists talk. Maybe this to mention that these findings are especially relevant with regard to adaptation, and to mention maybe a few concrete examples I would like to mention. One is a program called Adaptation, implemented by one PN member, namely Expertise France, and funded by a GEFIC member, namely AFD, of course, Agence Française de Développement, and just to mention that Adaptation supports countries and regional organizations, particularly vulnerable to climate change, in the implementation of their adaptation strategies. It aims to better understand adaptation processes, but also to support the translation of scientific knowledge into governance mechanisms, public policies, and adaptation investment. Another one maybe to mention, which is nice to focus on, is the Global Climate Change Alliance Plus, GCCA Plus West Africa program, which aims to set up the dialogue and cooperation in the fight against climate change between the European Union and the most vulnerable developing countries. The GCCA Plus initiative is continuing to support countries with two mutually reinforcing pillars, political and technical dialogue on one side, and support for the establishment of national and regional policies for climate change adaptation and mitigation on the other side. Another one I can mention as well is what is done through the Dutch Fund for Climate and Development, which is set up by the Dutch government and managed by a consortium formed by FMO, CFM, SNV, of course, and WWF Netherlands. The DFCD's mandate is designed to originate and develop new bankable climate projects with local private players, traditionally not supported by development by DFIs or commercial banks. And the consortium does so by identifying and supporting climate adaptation projects with technical assistance until they graduate to the bankable stage and are eligible to be scaled up and developed further thanks to an investment by FMO. Maybe to conclude and to leave the floor to the others, I would like to emphasize at the end the key role of technical assistance, and that the fact that technical assistance can enable better cooperation and collaboration between actors for more effective financing of adaptation, particularly in fragile contexts, which is very key. By strengthening complementarity between actors and maximizing the effects on resilience and systemic change, it can better assess and integrate climate risk into its risk strategies and approaches. Together, I think we can say that European donors, development agency, and DFIs, PDBs can be more effective in increasing funding for adaptation and resilience in light of cascading and transboundary climate impacts. Thank you so much, and I will be happy to follow up on question, of course. Thank you so much, Sam.
Thanks a lot, Jérôme. We have not coordinated exactly on what you would be going to say. Thanks a lot for mentioning the studies by the European think tank group. ECDPM is one of the members of the European think tank group that has been doing indeed some work for the practitioners network on the cooperation between implementing agencies, DFIs, and public development banks. And then, since I was leading that work with my colleagues, European think tank groups is also members from the Spain, France, Italy, Germany, and the UK. But I was also then doing the work on climate adaptation. That was also one of the elements when I was thinking, well, isn't it this kind of generic cooperation that we're talking about on climate adaptation, a typical area where sometimes we hear it's very difficult to find bankable projects for private to leverage private investments in climate adaptation. So that's what, combining some of these perspectives and then the cases that Jérôme was mentioning, I was wondering, is that one of the reasons why perhaps DFIs are not doing that much in terms of climate adaptation, because it is difficult to find bankable projects? And that turning to David, both now speaking for the associations of European DFIs, but also from the experience of, coming from FMO, Jérôme was talking about DFCD as one of the examples. How do you see these, perhaps some of the bottlenecks in order to boost the approach to climate adaptation? Is it simply working more with technical agencies and have more technical assistance, or are there other elements?
There are other elements.
Yes. To open up for you to other dimensions.
But on a positive note first, and Jérôme already mentioned the Dutch Fund for Climate and Development. I was involved in the start of that. At the time, the Dutch government gave a subsidy auction, basically, and we managed to get that subsidy with a very novel type of structure where we didn't think at all if it would work. It was having SNG and WWF locked into one larger program in an origination facility that they would manage totally. FMO would be the full fund manager. The origination facility is supposed to help make the assets and then bring to the pipelines of the two partners, to the larger financing partners in that consortium, which is FMO One and Climate Fund Managers, which is a daughter of FMO, specifically focused on climate finance and blended finance facilities. The evaluation of that is coming out soon, I can tell you, the first evaluation, and I'm happy to see what I've seen of that, to see already quite some positive results there. 5 years ago, I wouldn't have thought we would be sitting here talking about this so prominently around the adaptation fund. So it's really, there's a consensus that the bankability of projects in adaptation needs to increase, that we need to find ways to do that in a very structured and operational way, and then we need to find funding for that, of course. And that brings me to the other obstacles, and that's not such a positive story, to be honest. What you do see, let me start from the bigger obstacle that I think that is quite, it doesn't get a lot of attention in the adaptation finance space, but this, of all the sectors that we've been working in and of all the topics, this is in essence very much connected to power and influence structures. And if I may say that if you, as a DFI, you want to be the bridge between finance and opportunities, like every financial institution, but as a DFI in particular, opportunities that actually bring impact. You want societies to be resilient. What we often forget is that societies are actually living or being in a landscape, and the landscapes themselves are now under stress because of climate change, and it actually makes resources scarcer. And if resources become scarcer, if opportunities become less, we will find, typically, if there are no interventions, huge power and influence struggles. And I think that what is not highlighted enough is the governance aspect to climate adaptation. I think it's a huge obstacle. The fact that if it goes unchecked, you will have a vicious circle going downwards, where there is elite capture, where the rich get richer and the poor get poorer in a landscape. That landscape is quite crucial here. So I do think there's not enough attention to that. DFIs typically do not work in that space, obviously. We'll never do that, and that's good that we don't. But we do signal this. And it's also a challenge for DFIs. How do you actually tackle the risk related to these power and influence struggles, which is very different risk from I think, the risk that was identified around the tail end risk and the catastrophe risks, but identified in the first panels. We need to find a way together with the MDBs to deal with that. That's from the really top. Then the second level, huge obstacle, I think, that we all see is something that featured prominently in the first panel. That's data. So what is actually happening in the landscape? How does that affect the society? And what does that mean for the type of investments that you need, for the type of projects that you need to identify, both bankable and non-bankable? And then you need a certain kind of data, which again, it's not just about the tail end risk. This is about climate risk that is kind of intergenerational. So, I mean, we all see it around us here as well, in Belgium and in Europe. There is a slow change of the climate that just slowly permeates into the society, and it's often the elders in the community in Africa see it. They can vividly talk about it, but it's that kind of change that you want to capture, and those data are far more, well, I would say, sociological, almost anthropological data. That you see how the landscape is actually affecting, or the changes in the landscape is affecting the societies and the resilience of these societies. And now to make it a bit more concrete, where we can do something as DFIs, I think the third aspect where we, which is a large obstacle, is the actual availability of grant funding. This is something that you cannot have a financial return profile on in the first place. This is very early stage opportunity. You need grant funding to help set up or transform opportunities into bankable deals. It's very difficult to connect these to financial return in the end. So what you need to have is almost, I would say, the old-fashioned development cooperation that helps not so much the DFIs, but that helps partnership and partnership consortia to be in that early stage where opportunities can actually be turned into bankable deals. And that type of grant funding is very scarce. One of the reasons I think that the project, the pipeline is abominable and is just not sufficient at this moment. But it is very difficult to actually create a political momentum for this. At the European Commission, it's quite difficult to secure this type of grant funding at the scale that it is needed. We do need others like the bilateral governments to step up on this. And we do need, in particular, I think, if I may point that out, it's not in your report, but it's a huge player and it will be a huge player going forward. We do need a Green Climate Fund to get its act together and help move the needle on the availability of grants for climate adaptation projects, particularly around bankability. And then the fourth obstacle is ourselves. That sounds a bit strange, but the DFIs are, I'm looking at my FD colleagues, so I'm going to say something that may not be, this is my third week on it. But we're just not organized in the way that you need to be organized to actually capture these opportunities. First of all, it's that tension within each DFI, in particular those that are bank regulated, between the risk departments, the credit departments, and the investment officers that get told to move out there, and the risk departments that have their connections with the central bank that are being told completely differently. So that tension is it's a challenge for DFIs to manage that tension. The second challenge for DFIs is what I would call partnership capability. DFIs are just not geared towards partnerships. The type of partnership that Jerome just mentioned with a NGO or with an early stage project developer to make this the pipelines bankable is a very different kind of partnership than you have with a client. DFIs have a deal culture. They do not have a programmatic culture, and they need to change that. And I think that partnership capability is a very important aspect here. I think we're actually on the right track at this moment by having this much closer cooperation with and these experiments that are taking place between NGOs and DFIs. We're also on the right track in terms of the reception of our message to donors that grant funding is needed. At least they're listening. And we do see a lot of obstacles within the European Commission and clearly within the Green Climate Fund, but there is some momentum coming. So I want to end here on that positive note. And if you don't have the slide here, but you presented that as the ecosystem for climate adaptation. There's an enormous part missing there. This is all local. So you need to also have a very important role for the local players in that ecosystem. And the slide needs to be adapted, I think, in the future to make clear that this is a local agenda by definition, and opportunities can only be seized and made into bankable deals if it's done by local partners. So far, it was a simple question.
Great, thanks a lot. Starting from the very systemic issue to self-assessment. By the way, the slide was not about the ecosystem, it was about the European system. So it was purely about European actors and how European actors, you were saying, you know, it is difficult to work, and we see that you might be on the right track. I would wish that's the case, but the track is perhaps going too slowly on that track. You, not just you, but I mean collectively at the probably less at the local level. Daniel, I'm looking at him because he's also doing some work. We're also working on what are the dimensions and tractions at the local level. But given the urgency of the needs that are expected on the ground, and also the political dynamics to some extent, that when we talk about the failures of the COP and so on, what they can deliver, a lot of developing countries are saying you need to do more than simply telling us we're green, but you need to address our direct concerns, which also how to become more resilient to climate change. And then perhaps for actors to say we're on the right track, but at this very slow pace will not we have to listen more to a few other applications on how to tackle the obstacles and how to change the way we work together to go much faster. And that's perhaps what's typically what you know, the EIB, the European Investment Bank, Michael Rattinger, you are probably as the EU bank on the EU climate bank at the same time, you know, with ambitious roadmaps and approaches on how to finance climate in a more effective way. It is, from an outsider's perspective, a bit discouraging to see that there's, you know, around 10% of climate adaptation, that's climate finance that goes to adaptation. And I remember when we started the Cascades project, Horizon 2020, in 2019, we wrote a brief already highlighting that I think at that time, we were around 11%. And we were saying, we hope it would go to the 15% of EBRD, and EBRD fell back to 5%, and you roughly around 10%. So what are some of the dynamics perhaps that are missing there? You know, I was talking about the track perhaps going too slowly on that track, though proportionally that was when we were looking at initially, there was before the climate roadmap by the EIB. At the same time, I have to mention, I mentioned David was coming from FMO. You are coming from the Asian Development Bank, where the Asian Development Bank is having 40% of its climate finance dedicated to climate adaptation. So is there perhaps there, you know, when we're talking about local actors, is there some lessons from that could come also from the Asian development?
Okay, first of all, thanks Sam, and thanks ECDPM for the invitation. I think it's a great opportunity and a fantastic topic, and I really commend you for the report that you wrote, which I think raises a lot of the issues that we, in more or less of different extents, are looking at. You said that, so I'm speaking now, I have two hats, Asian Development Bank, EIB. So speaking from the EIB perspective, yes, absolutely. You know, what we're facing in addition to all the other banks is a huge financing gap. We look at what the countries are saying in terms of the financing need for adaptation in Africa alone. If you look at the MDBs, it's somewhere in the region of $40 billion US per year. We are delivering about a fourth of that right now. So we need to collectively increase by 4 at least what we're doing on adaptation in Africa and also in other places in the world. Even taking into account that the estimates in the nationally determined contributions and other plans might be severely understated and might, of course, also increase the less we do something about mitigation, right? So we're looking at a price tag that is very large, that we're not meeting, and that is growing very quickly. So with that in mind, you know, if we look at sort of what, just Africa specifically, what adaptation finance is flowing, about half of that is coming from the MDBs, the multilateral development banks. About 1/3 is coming from local, 1/4, excuse me, is coming from local governments, and the rest from the private sector. So all of those need to step up. And when it comes to ourselves, first of all, what can we do as the EIB, as the multilateral development banks? The first thing is to set targets, you know, is to identify where we are and to set ambitious targets. And that's what the bank did in 2019, setting a target, which is basically saying that the EIB will devote half of its pipeline by 2025 to climate, and of that, 15% will be for adaptation. So if you do the math, if we reach our targets, about 7.5% of our overall portfolio. That was 3 times the level when we made that commitment in 6 years. And if you know something about infrastructure investment, which is most of what we do, those projects have a very long lead time. You can't just invent projects, you know, they don't just sit around in a filing cabinet. You need to identify them, develop them, find the partners, and so on. So to say that we will triple adaptation finance in a relatively short period of time was kind of an electric shock for us internally. And I think one that, you know, sure, if you take 1 year, it might fall or rise relative to the other, but the important thing is the trend. And I have to say that, you know, the target of 2025, meeting that target, I'm fairly confident that the bank will do that. The question is, can it do it sustainably, and can we do more after that, right? So how can we do more? It's working together with our partners. And there I have to say that the EIB, maybe as opposed to others, is a bank built on partnership, because we're not only owned and governed by the member states and take direction from European policy abroad, but we are in our DNA limited by the volume of projects that we can finance. So usually in a project that EIB is involved in, we can finance a maximum of 50%. So we need other partners in all of our projects. So that means very often the EDFIs, who we regard as, you know, part of Team Europe, a very important part of Team Europe. And so we always carry the blue flag with the golden stars wherever we go. So when we look at what local governments have to do, they obviously have to, first of all, identify the problem and address it with urgency. We see that in many countries, the issue of adaptation is underdiagnosed. There is a latent need for adaptation finance, but it's not explicit. It's not in plans, and what's not in plans is not prioritized in budgets. What's not prioritized in budgets does not get financed. First of all, there needs to be an awareness raising of local decision makers about climate risks. And here's where the work that you all are doing is so incredibly important. We need to make that data and those insights that you're producing actionable for decision makers. That means they need to reach decision makers and need to be in a form where decision makers can take concrete steps to improve the situation that they're in. So if that doesn't happen, then the whole mechanism of engaging with the EIB and multilateral development banks breaks down, because we are led by domestic policies and domestic plans. If adaptation is not integrated in those plans and given priority even from the domestic budget, then there's, you know, there's a breakdown in that bridge that we need. So it's extremely important that countries do this work, including with our help, to see what their needs are on adaptation investment, what they can cover on their own, and where the gap is and how that can be filled. We, multilateral development banks, can only serve as a bridge. I mean, even if we put all of our financial firepower, it's a drop in the ocean. So what really needs to happen is the local government needs to see what it can do in terms of mobilizing resources. That often means working in a very constrained fiscal situation, high indebtedness, very complicated to do, especially in more low income and fragile countries. But we also have to look to the private sector. The private sector is a very important player, because if you look at climate investment in the OECD countries, 90+% is the private sector. In fragile and conflict-affected countries, it can be 50% or less, right? So we really need to find ways to work together with the private sector. And this is something that at EIB we do sort of across the entire spectrum, from, you know, seed capital for early stage development through to, you know, senior loans for mature technologies, right? It's trying to find those opportunities in order for the private sector to move in. And, you know, we also have to get the private sector to realize that, you know, their operations are subject to climate risk. They need to know what it means to work in a world that has, you know, increasing climate impacts. But we also have to let the private sector know that there's opportunities. You know, there is a great need to develop and deploy solutions.
Right? What we hear from many private sector actors, and echoed by DFIs, is that there's not enough bankable projects. And while you can have good returns on mitigation, when it comes to adaptation, it really, what is your experience when you have been trying to mobilize also the private finance?
Well, you know, it is tricky, because when you are financing a mitigation project, let's say an energy project or a transport project, you are creating a service, energy service, transport services that have a revenue stream. Somebody is paying for these services. Now, who is paying in an adaptation project? What is the revenue stream that you can turn into a repayment stream for a bank? In many cases, that doesn't exist, right? So that's a fundamental issue, is that lack of a revenue stream, unless you look at certain fringe cases, for example, having to pay less for insurance because you are, less climate vulnerable. That enlightened insurance companies can say, well, if you're taking measures to be less climate vulnerable, I can lower your premiums. But, knowing human nature a little bit, and as economists, we study human nature a lot. Human beings are more motivated by what they can earn than what they can save, right? Or what, So in that sense, there is a kind of mismatch between the financial instruments that we have today, which, investors love long-term, stable, predictable flows of finance with minimum risk. This is what will get everybody going. But if it starts to break down at some point, then you have an issue. So can you do something in order to, let's say, enhance how you structure the project financially? Is there any way that you can create revenue flows from there? Is there any way that you can lower the cost of capital for those types of investments by, let's say, providing some de-risking, either enhancing the credit worthiness of the counterpart, providing cheaper finance? You have to each project will require a sort of tailor-made package, although there's obviously projects that can be replicated and scaled up. It comes back to something that you said earlier, which is about political expectation. I think that is a very important factor, because if on the one level, developing countries are in the climate negotiations saying that they wish, not to further indebt themselves in order to finance the adaptation that they need in order to respond to climate change that has not been caused by them, why should loans be the preferred instrument? There should be either full concessionality or other types of needs. And here we have to navigate, those two poles, because as the multilaterals, we are sort of a bridge between the two. Here it comes to sort of your Asian Development Bank question. It's a matter of what function these banks play, right? And the EIB is very much a European bank, and the Asian Development Bank is a bank owned also by the countries, the Asian and Pacific countries where you operate, where those expectations will be higher, right? So you have a kind of negotiation process that would probably favor, politically even speaking, the use of grants for adaptation financing. I also have to say that just because I finish up, I'm talking too long, but that diagram which I find so useful about the sort of European ecosystem. At the bottom were, and I hope that's not because of your opinion of us, but at the bottom were EIB and EBRD. Maybe also we can consider the regional development banks, Asian Development Bank, African Development Bank, Inter-American Development Bank, and the World Bank even, as not fully European, but partially European, in the sense that important groups of shareholders are European countries and EU member states. And I have to say, from my modest experience of having worked for several of these banks, it was often the European countries and constituencies that were most pushing for an ambitious course on climate. Of course, that negotiation process internally then took place, but we need European leadership in these institutions. And leadership, not only verbal leadership, also means finance and other types of support. So I think also at the level of the European countries, there should be maybe a bit of a strategic look at, what role Europe plays in all the banks that is involved, how those can be maximized for what we want to happen, which is more European involvement and ultimately more adaptation.
Yeah. Great, thanks a lot. That's a perfect position to talk to Christine Müller from DG Climate. I hope you're feeling all right, at least to talk to us. Sorry, Christine, thanks a lot for joining us. It's highly appreciated that you have a special effort today. You have heard these comments that we need both the political guidance, we need perhaps to combine better grants and loans, different kind of actors together. And in our model, a lot of people have been captured by this image of the European ecosystem. At the center was the European Commission. So what is your perspective on, how to unleash, knowing that, of course, you have also, the Commission has pushed a very ambitious climate adaptation agenda.
Yes. So, hello everyone. So I'm sorry that I cannot be with you in person. So I hope the communication works also remotely. Indeed, I would say that, a key priority is really the careful risk management that generates trust and cohesion, and also, the necessary drive, confidence to achieve, joint objectives together. We have examples ongoing, so Team Europe initiatives, like the Climate Adaptation and Resilience in Africa initiative. We all know that climate change and related disasters impair peace and security, and Team Europe and Africa are working indeed to find new ways to address Africa's growing adaptation and disaster risk reduction needs in alignment, with the African Union's Agenda 2063 and also the African Union Climate Change and Resilience Development Strategy and Action Plan from 2022 and 2032. So it is really designed to support Africa-owned solutions and to strengthen the role of the African Union as a coordinator of the management of cascading climate change impacts across the continent. So we have Team Europe initiative actions with a positive impact, on high conflict risk areas. This impact also includes, of course, the predictability of financial management and cooperation between financial actors. So with focus on the Sahel, Horn of Africa, the North African region. The EU is also very active in supporting climate action in sub-Saharan Africa. And as good examples, I would like to mention the initiatives Natur Africa and also the Red Green Wall. Both cover several countries from the Sahel and the Horn of Africa. We also have the Team Europe initiative in Mali on environment and climate change, and that's another example, of our engagement and action in that field. So, but very concretely, I would say the first step really for a fruitful cooperation of financing partners, but within the ecosystem of the overall partnership necessary to make change happen. It's important to have a risk assessment, right, which is context specific and science-based, and looks really at cascading climate and conflict risks. And based on such an assessment, the development of a stakeholder-supported development roadmap towards climate resiliency and security is possible. So a key role have really national and subnational governments. They should include and prioritize the analysis and the assessment really of cascading and transboundary climate risks in their adaptation policy cycle, and also, in their national planning process, be them adaptation plans, strategies, and also multi-sectoral instruments. So a relevant example for Africa could really be current engagement in building climate resilient food systems from the household level really to the farm level. And also connected with this, the explicit monitoring and verification and also certification in the reward of climate and biodiversity benefits. The idea would be to close nutritional gaps via planetary health diets, and then, via these more diverse diets, create opportunities for local regional land use with the mentioned climate and environmental benefits. There's an opportunity to also include, in such a broader partnership for change in food systems in this case, the agricultural input industry like renewable energy and also regional electricity providers, the seeds, fertilizer, plant protection industry, but also the farm machinery industry, road modernization investments, logistics and marketing, product storage and processing investments. So one can think to leverage the Global Europe initiatives, which are offered by the European Union, For example, the Food Security and Resilience Funding in ACP countries initiative. We have a very clear results framework for targeted intervention and action planning in our international partnership instrument. And we could use also the cooperation and working fora, like steering committees and working groups and task force, of the European Development Finance Institutes, the public development banks, and also the, of the network of the development practitioners. One could leverage, again, staying in this example case, the SUN, the Scaling Up Nutrition Movement, but also the UN Food System Summit follow-up work with various coalitions and alliances, and also, the COP27, ICANN, and FAST initiatives, on better nutrition and food and agriculture for sustainable transformation. So this is just an example of, connected to existing EU partnership engagement in Africa, but also in other countries, Caribbean and Pacific countries. One can build partnerships based on a very detailed, comprehensive risk assessment that is developed in partnership, using this then really to addressing these risks and building roadmaps, constructing roadmaps to achieve better outcomes. So such roadmaps would need to be made up really by a pathway, of step-by-step action, and the actions building on each other, delivering interdependent milestones towards the final resilience goal. So consensus would need to be agreed on such a roadmap, and this roadmap definitely would have to be backed by an impact assessment that clearly describes the expected roles and actions of each stakeholder involved, with a kind of within a sealed partnership, including diverse and adapted and feasible financial solutions. And I think we really have to draw from the whole toolbox that we have, plus upcoming new innovative solutions. So such diverse approach to financing within trusted partnerships would really be the game changer. So in this way, we would be able to have a solid risk anticipation and also adaptation planning process. Stakeholders become aware of what is expected and what should be delivered, of the benefits, but also the needed efforts. And in this way, get also aware of the buy-in of a critical mass of, members which carry such a partnership and sharing the overall risk together. So from a European perspective, we could also hint at a good example that now started to be implemented in Europe. So the climate risk assessment in Europe under the EU adaptation strategy, where DG Klima and also the European Environmental Agency, we initiated the preparation of this first European climate risk assessment. And this will assess the current and future climate change impacts and the risks related to the environment, the economy, and also the wider society in Europe. Finally, also last but not least, I wanted to mention the UN Early Warning for All initiative, with its 4 pillars, and also the work under these 4 pillars, the partnerships which are already established can be leveraged, for climate risk assessments and other adaptation planning process actions. Thank you. Over to you.
Thanks a lot, Christina. Perhaps just one quick follow-up question. What would it take? I mean, the idea of a roadmap is quite enticing, but what would it take to make it a reality? You identify, a lot of possibilities of synergy and working together, but it seems, again, looking at this, being on the sideline, that, well, these are good intentions, but we need to move to action. So what would it take to transform these good intentions into concrete roadmap for action?
Yes.
What are the challenges, perhaps bottlenecks or elements that you would see as critical issues?
Yes, I would keep my response short in the sense that I would say, let's continue on the road that we have already started to embark on, because we are working indeed, on the integration of resilience building in policy making and raising awareness on this issue. You know, the EU supports, as you know, an African work stream, you know, with adaptation planners and the African Union. We support the development indeed of such a roadmap, you know, for the implementation of the African Union's climate change and resilient development strategy. So we are on this, working in partnership in the context of our external action. And as I had outlined before, I think it would be very useful to leverage really the fora, the discussion and cooperation fora of various existing initiatives, you know, like, for example, steering committees, working groups, and task forces, for example, of, you know, of the practitioners network on development that already exists.
Great, thank you very much. I'm sure you have plenty of questions for the people in the room or people online. So for the people online, just you know, raise your hands if you want to speak or put your camera on. So I see Daniel Brink already interested. Please go ahead and unmute yourself. Yep. Daniel, we don't hear you. Can you speak? You're not unmuted.
Hear you, I think. Do you hear me?
Yeah, now we hear you.
Okay, yeah, perfect. Yeah, well, first of all, thank you very much for the presentations and the panel discussion. It's very interesting. I'm Daniel. I work at the MFA of the Netherlands in the Innovative Finance for Development team, and we try for the MFA, from the MFA, we try to mobilize actually private finance for the development goals and to contribute to those aims. Yeah, so my question or remark, I think it's a bit of both, mainly relates to comments by David and Cinzia. So you were talking about this bankability of projects and business models, and I think for adaptation, that's really, yeah, really the well, maybe not the main point, but a very important challenge to solve, because of course business models are not always that clear for adaptation. So I would say, and I wonder what you think about that. Of course, de-risking and blending is necessary, at least to some degree, maybe to achieve some demonstration effects at first. But for other adaptation fields, it might remain necessary. However, the amount of ODA, of official development aid, that's currently available for blending is very, very limited. Only like 3 to 4 billion a year. And whereas the adaptation funding needs for emerging markets, well, I saw somewhere a figure of 300 to 400 billion a year. So I would be curious, and what I actually would think is needed is a more detailed investigation of which adaptation terrains are suitable to actual private investment cases, to build private investment cases for, which terrains might be a bit, you know, tricky, but can be done, and some other terrains might actually never be really investable for private investors, and that's also something to be honest about, maybe. So I know the OECD has done some work on this already, and they released it in a paper recently, but that's what I feel is lacking sometimes a bit. You know, we are asking for the private sector to step in, but we also need to make clear, okay, which fields can the private sector jump in, what de-risking is needed with the scarce money available, and to really go a step further in investigating that. So I'm curious what your thoughts are about this.
Thanks a lot.
Maybe I'll take a first shot at this. Thanks, Daniel. It's first of all very important not to look at adaptation only with the public lens. A lot of this agenda, investment agenda, is public. We just I think, all realize that and all accept that. And in fact, it's extremely important for the private sector that those public investments take place. But there is a part which basically is where resilience is almost like doing things different. So doing agriculture different is requires an upfront investment on business models that are already there. I mean, it's a farm. It's a sustainable land use. Introduce crop resilient, climate resilient crops. That requires a lot of investment. That's still risky, so that does require some public funding. And there are, of course, in the agriculture space in particular, initiatives that have not even much to do with risk, that are very much opportunities because of climate change and because a landscape is changing. And those type of investments we need to target for private funding, because they've always been privately funded. And if I can give you a large example, I think it's particular in forestry. If we want the biodiversity agenda to succeed, if the public biodiversity agenda to succeed, if we want rainforests to stop from being deforested and to grow again, we actually do need a lot of different practices that are where it's essential that private actors change behavior and that value chains are changing. There can't be any public investment there, but that's extremely relevant for climate adaptation. One last thing is actually you do need, like your own, Daniel, Dutch Fund for Climate and Development, you do need those programs to experiment, to see what works and what doesn't, and to also try to scale it up. So that's very important. Is another reason why the grant funding is so important, is to have more of these type of programs that actually produce data that help us make far more standardized asset classes in this area.
Maybe just add a little bit. No, absolutely. I think we should appeal to the sense of self-interest of the private sector, but also the sense of self-preservation. I think the private sector needs to have a very serious look at supply chains, and it seriously needs to take a look at what is happening in their target markets. Consumer preferences are changing. Consumers have more information, etc. But locally, where we intervene with financing, if we are, let's say, looking at an island nation in the Pacific, there is not much of a private sector to speak of, except, for example, let's say the tourism industry. You could work together with enlightened parts of the tourism industry to say, listen, your business is not going to be sustainable unless you control the storm surge. Otherwise your hotel infrastructure is gone. So maybe there you have more of a propensity to invest in, let's say, mangrove reforestation or some kind of sensible management of the natural resources, which then would also it's private investment that benefits publicly, because the hinterland behind those hotels would also be protected from storm surges, right? So it's to find those spots where you need private sector leadership out of a sense of, if it's a business opportunity, but also self-preservation, but where you can link that to the public benefits, right? And there are, tourism industry could be an example. The banking sector is another one. The banking sector doesn't want to wake up tomorrow morning and find half of its loan book is gone because they have been lending irresponsibly to, agricultural enterprises without checking the viability of their business model. So things like this, I think, if it doesn't come from regulation in the countries, which might take a while to catch on, maybe encouraging that more forward-looking perspective that some parts of the private sector have, to impose a kind of new business standard. There's nothing that inspires a private sector actor more than another member of their sector that is being successful with something. They'll immediately want to copy it, right? This happens a lot in banking. So can we find those examples all together? I think that will be important.
And can I bring one message to your minister, Daniel?
Go on.
big message. Go ahead.
Other message to your minister is the question, does this all need to be financed by ODA? Don't we need another type of funding, in particular for this, for climate finance? ODA is a, I think it's very good that, like in the Netherlands, you connect that to the GDP, but that's definitely, even if you do the 0.7, that's insufficient for this type of investments. So there's a bit of a, from the DFIs and maybe also MDBs to you, Daniel, and a message to your minister, there are urgently other sources of financing needed, in particular for climate finance.
You mean other sources of public finance?
Public finance, sorry, public finance to, well, basically to do this moonshot operation, which it is. And the ODA mechanism is, I think, insufficient to deal with an agenda of this size.
Can I follow up? Because are you talking about other sources of financing for adaptation in emerging markets, or just within the Netherlands, for example?
No, I'm talking about a global realization that ODA is insufficient and that you do need other sources of international public investments than just ODA. I know it's way beyond everyone's pay scale here, including yours, but it is something that, also because we're here at an adaptation, and what was just said by my neighbor about the enormous lack of financing climate adaptation, you do need a different look at this from a public perspective.
Interesting, thank you.
Yeah,
I've written it down.
It's not very good. It's good to think beyond, the existing model of everything on ODA. Yes, please.
Yeah, hi, I'll stand, but also can't see you. Well, the last comment about ODA and climate finance.
Just introduce yourself.
Oh, sorry, I'm Belinda Petrie from One World Sustainable Investment Fund, mostly based in South Africa. Michael, my question's for you, but before I go there, I'm just a little bit sort of thrown by your point of ODA versus climate finance. I remember, I'm old enough to remember the days when climate finance came up big on the agenda, and everyone was going, it needs to be something extra to ODA, and it's been a fraught journey. And I also thought climate finance was meant for adaptation and mitigation. I think we just haven't got there. So I worry about something additional, again, an additionality argument. But Michael, my question's for you. I mean, in addition to the preservation and self-interest among the private sector story here, there's also the incentive. And we're about to start a project for EIB, but on the mitigation side. And I quite like the mechanism, and I was wondering if it couldn't apply to adaptation finance as well. So it's a very practical question, and possibly also to the public sector. So the mechanism that we work with the EIB on is to decarbonize an energy company in Africa that applied for, in this instance, loan finance, but it's a fossil fuel-based organization, and so the EIB said, fine, we'll give you the loan, but you need to decarbonize, and we'll support your decarbonization strategy. And I think that, many of the commercial banks are looking at de-risking their investments to the private sector, because they are worried about adaptation risk. And I just wonder if such a mechanism couldn't apply. And the reason I said may also apply to the public sector is that a lot of adaptation in the end, and a lot of the disasters that we face are both adaptation and business as usual issues. So floods in Pakistan, KwaZulu-Natal, like we had a couple of years ago in South Africa, and that was both, excessive rainfall, climate event, but also poor infrastructure design for climate resilience. And you guys also were blessed as DFIs to address this, and so that's how I
Thanks a lot. Just No, I'm not familiar with that specifically what you were saying, but you know, meeting your project counterparts where they are and helping them to transition is very important, right? And in the case of the EIB, it's, you know, let's say if we are providing funding to a company, they need to prove to us that they have plans to be Paris aligned, right? Otherwise, we cannot lend, we cannot because of leakage issues and whatever, right? So looking at it from the, you know, the Paris alignment is mostly looked at from the mitigation side, but there is also a Paris alignment goal on adaptation, right, which we shouldn't forget, which is we should equally be asking of companies, you know, how do you see your future prospering, you know, with this future climate scenario that might happen, right? I mean, it's probably little use to you if you as a company are resilient, but you're operating in the middle of Pakistan where there have been, you know, let's say infrastructural insufficiencies, right, that have exacerbated the situation, right? So that's a way, I think, where you can connect the public and the private to the public again, where the private sector will make investment decisions based on the credibility of public plans to ensure that the investments that the private sector makes are actually, you know, made more climate resilient by publicly driven investment, right? You see all over, let's say, Southeast Asia, where most of the capital cities are on the coast, huge investment in real estate, private sector driven. And this, you know, cities are sinking into the ocean, right? I mean, if the private sector were aware of this, they would demand, you know, of the public decision makers to do something about this, or they would withhold investment, right? When there were floods in Thailand in 2011, very serious ones, and some of the more enlightened companies did go and ask the government, say, look, we just got all our operations wiped away here. You know, Sony, PlayStation, global launch was postponed because of this, billions of losses, right? So the company is going to the government and saying, you know, what assurances can you give me that the infrastructure where I'm going to be investing, you know, around or in is actually climate proof, right? So this is a way to create this public-private dialogue because no one will be resilient on their own, right? I mean, you sink or swim with everybody, right? There could maybe be a space for some performance-related financial instruments to say, you know, if you invest and then, you know, the flood risk went down or there was a flood and less was destroyed. I know you have to, you know, kind of calibrate this carefully, but there are ways to kind of incentivize smarter decision-making around infrastructure and connect it to that private sector investment that is hooked into everything, you know, power grids, roads, water, everything like that, right? So it's a work in progress, I think.
Yeah, there are many hands in the room. Just anybody online who wants to switch the camera on and intervene? Let you think, then I'm going to Matoya first. Then, yeah.
Thank you, San, and thank you so much, Mike and Cristina. My name is Matoya Wolf. I'm the representative of the Spanish Agency for Development Cooperation and also holding the presidency of TEFIC for a rotatory presidency for 1 year. We started on the 1st of July together with the Spanish EU Council presidency. So it happens that we do have a culture of partnership also with our ministry. But of course, in DFIC, we are all very different animals, but we have also built on a partnership culture because DFIC was launched last year at the EBRD, but we were working on the enhanced partnership that was back in 2007, if I remember well. So maybe there's a cultural difference between PDBs and DFIs because you work with the private sector mostly, and we work very much with the public sector, but also with the private sector. Maybe we can bring to the table as technical members this culture of partnership. Actually, that's always the debate between competition and cooperation. We are, so IT is a cooperation agency, and we have that in the DNA. IT, just for the commercial, we are a holistic and strategic agency. That means that we have a part of the agency, the traditional one is about technical cooperation, but an increasing one, the branch of finance development that is really increasing with the new law, international cooperation, the Spanish that has passed, that is entered into force at the beginning of this year.
So, I have one for you.
Okay.
I have your experience because within one agency you combine the two elements, and we have heard we need to have more partnership between the technical assistance and the finance. Do you have any good examples and perhaps also some of the bottlenecks that exist through this cooperation? Sorry, I cannot just let you ask a question. I have to ask you one.
Okay, sure. Yeah.
Great strategy.
We have to get the expertise in the room. We have to learn.
I will start with the bottleneck, maybe. The bottleneck is some culture of more technical cooperation within our human capital. An asset is our deployment on the ground, long-lasting deployment on the ground, not only in Latin America and the Caribbean, that is logic, but also the Mediterranean, the Sahel, and Lusophone Africa, and also the Philippines. So, sorry, we are just in the Philippines for the time being. We used to be also in Vietnam and Cambodia, but we reduced with the financial crisis to a set of 25. So concrete examples in the area of identifying opportunities for bankable projects through our technical cooperation teams in the ground, because they have a very deep and trustfully dialogue with multiple stakeholders on the ground. And this deep and trustfully knowledge of the ground is an asset for us. So I would stop there. Maybe we can give.
But does it lead? Sorry, I'll push you one extra bit. I mean, does the fact that you are on the ground and you have this technical expertise, does it lead to concrete projects where you can invest? Because this is, we hear a lot. I mean, there are few examples, but when we're talking about scaling up, it seems that when we're talking about cooperation, we say, well, we should have better connection between technical assistance, presence on the ground, ecosystem, and the financiers. But this is easier in words than in practice.
It has led to concrete examples, for example, in the area of WASH. So in Latin America and the Caribbean, different examples. One of them is quite an interesting one, the 5D in Guayaquil, for example. So it has led to concrete projects. Yes.
You can ask a question.
Okay. I would have one question and then one comment to Mike. The question is from the EAD that you said that the EAD could help in the endeavor of awareness raising at the local level. So how concretely you can help with that? You have concrete examples. That would be nice. And my comment, maybe quite a provocative one, is on the lack of projects of adaptation. You said that, of course, it's about not a direct revenue compared to the mitigation one, but that indirectly it can lead to, for example, a reduction on the prime of insurance. So don't you think, it's a common question, don't you think that women coming to decision level would go for more a mid-term approach than a short-term thing? Maybe it's a little bit provocative. Women bringing this mid-term approach and also bringing men that bring this mid-term approach. Finally, just to comment on the new ways of public financing beyond ODA, that would be a question. Is the OECD level on the TOST issue some point on adaptation now? Is it a focal point or not? Thank you.
Okay, let's perhaps, because I'm aware of time running out, so let's collect the questions and then I can turn to the panel for quick answers. Yes.
Yes, I have 3 questions or 3 short points, but I can try to keep it short. So one thing is that we also at the World Bank, we also combine very often the TA component with the financing component. We try to do as much as possible in this direction as well. And for instance, the Philippines, we also had a project where specifically at the World Bank, yeah. Or specifically the risk assessment led to like disaster risk financing lending component, which we also then had in this direction. So this is also something we try to do more, but it is challenging. And I think also like the question is now related to this. So how do you actually measure the adaptation investments as well, adaptation beyond, let's say, these big scale infrastructure projects? But it's a lot that also the private sector is doing it by themselves, you know, very small scale projects, very small adaptation things. How do we measure this? How do we bring this forward? And then the last point I wanted to make also related to the first presentation we saw today. So I think you also mentioned it before, you said, okay, the private sector would have an own interest to invest as well into adaptation at some point. But I think this hinges, and you also mentioned this, a lot on the risk perception at the end, right? And then knowing the methodologies that we have at hand, knowing how diverse the range of estimates actually is with respect to future climate damages, climate impacts, also shows you how challenging it is to influence the risk perception in this direction. For instance, we saw how the tail risks, for instance, how much they matter, how important they are. And at the moment, I think we still don't look enough and sufficiently into this, and also the private sector does not sufficiently look into this. So I think just as a common question for you as well in this direction. Thank you.
So we are actually following on a couple of points here. I'm Thibault from BioInvest, so I'm a DFI member. And definitely, I was wondering, like, jumping on this we are looking at numbers about climate finance from DFIs being really low. And DFIs, yes, we're really focusing on private sector initiative and fully agree that the role of public is key. And the business models for really adaptation is not yet clear for private sector. But really jumping on this, like the project you mentioned is actually, yes, like sustainability linked loans or those kind of instruments don't really qualify for climate finance from MDB perspective, like the common principles, etc., would really qualify. So isn't it more important to really identify the business that are really adapted already and ready for the transformation, rather than really trying to identify climate adaptation projects that are fully bankable? So yeah, you have a few business models like water management companies that offer services for the agricultural value chain. You're like, I don't know, insurance products or agri-tech or something like those business models could be bankable, of course, and like really qualifying for adaptation finance. But really looking at those projects that are already adapted, it's not really focusing on adaptation. So it doesn't really qualify for adaptation finance, but like private sector would have a really clear benefit to really identify those. And that's where the gap for qualitative data, understanding the risk. And so really, I think DFI should focus first on technical assistance, helping the clients to understand their risk and developing those initiatives, rather than trying to really grow the pipeline of purely adapted projects. And so that's where the numbers maybe don't really reflect the actions that are already done by private sector investors.
And I cannot resist adding, help finance those private sectors that are coming with adaptation solutions.
Yeah.
No, I mean, it's something that is dynamic. Who wants to start answering? Perhaps I'll come with the, because we have to go to, we have another 4 minutes. So quickly, perhaps, do you want Jérôme to address some of the questions? You're online? If you are still online? No? Christine, you're with us. Do you want to add something to the points that were raised?
Thank you. A last word, if I may. Indeed, so often mitigation adaptation action have co-benefits. And if we want really to go for systemic change, for transformatory change, we also need, systemic investment chains. And when I said before that we are on our way, I was also looking at the EU Global Gateway initiative, where we want to really invest in smart, secure, and clean links, bringing various sectors together and really allowing for a more comprehensive transformative change. And indeed, the principle, as it is also reflected in the Global Gateway Forum, which will come up at the end of October here in Brussels, The principle is really to present investment gaps, present needs, and then get stakeholders together to discuss, how these needs can be addressed, so that we can really find practical, feasible solutions to meet the investment gaps. And adaptation is also an important aspect which will be addressed. Thank you. Over to you.
Thanks a lot, Christina. And again, thank you so much for joining us. Systemic investment.
Many things and great ideas. Maybe from, if I miss some.
Yeah. So the issue is on partnership.
Yeah, how in practice, what we count as adaptation and not is kind of something that has been evolving over time, right? So the multilaterals have been doing it over the last 10 years or so since the Doha COP. They got serious about saying, okay, on adaptation, what are we actually doing? What is adaptation? Okay, there's a methodology. There's an annual report you might have seen, right? And now as the EIB, obviously we have the EU taxonomy, right, which is the primary, it obviously overrules whatever voluntary system of reporting that we have. But so what is adaptation is what we count as that, right? Should a monitoring system turn into a proactive business strategy? Maybe not, yeah? Should we be driven by taxonomies to find exactly those projects that will give us the benefit and not look at things like replicability, scalability, efficiency and effective use of financing, a private sector uptake? All those are, those are other considerations where you might argue the systemic impact will be higher. If we have a limited number of euros for adaptation, what should we do with them? Right? That's a big question. And I think it should not be, we should not purpose build projects only because we can check a box and say, we did this much adaptation plans, which brings me to sort of second point, which is a lot of the discussions around inputs. How much money are we spending on X? What results is it getting? Is it the best use of the money? Did people actually become more resilient and less vulnerable? All of those things are not fed back into the loop to say, well, hold on, this is not the best. The best use of our money is maybe to find small, cheap technology that can be rolled out across the globe or maybe across the Sahel or whatever areas in 10 years and work from that, But that's kind of would be changing the way that traditionally we have been working so far, which is, you need to deliver X amount of finance into these areas. Looking at the issue of risk perception, that's very, I think it's a key one because risk then kind of makes you think about urgency and prioritization. And I guess what is a risk for some, for others, is just something that they live with. But I think overall, it shows that there is a great need for climate-related communication, right? So there is quality data, quality information, but it's not reaching the decision makers either at a private company level or at a government level in a way that they can use, right? So how do we, first of all, as banks, use the most advanced knowledge that great scientists are producing in Europe to inform our own decisions and what we tell people they can use as tools, are we really doing that, right? We should do that. So there's a kind of science policy interface that really needs to be strengthened. And here I also think that sort of joint diagnostics are very useful. The World Bank is doing great work with these country climate and development reports, which are country profiles where you can, it's basically up-to-date science of what sectors are the most, contributing most to climate change. We have something at the EBRD, which we're doing with the World Bank, which are country climate risk profiles. The EIB has an own scoring system, but to really make this a little bit more open source in a way, to say there's no need for 10 different entities to look at climate risk and come to different conclusions. Can we pool some efforts there and kind of build a narrative also in our dialogue with the decision makers locally? Because we have to understand that the transaction costs for individual countries to deal with all of us are very high. They might receive a delegation from IT, from us, from the University of Vienna, University of Vienna Business and Economics, my alma mater, by the way. And they don't have time for all of us, right? So if we are doing work upstream, let's coordinate amongst ourselves and find a way where we can minimize the the cost for the local decision makers to engage with us, because otherwise we swamp them. We see that sometimes in MDB projects, just because you gave somebody €100,000 technical assistance for the next 5 years, they have to come and visit you 3 times a year and write reports and all of this. You know, we have to rationalize this in some way. But
yeah, no, that's we're over time, he says also, so I have not much, nothing to add to that, except for in this respect, the GEMS database is extremely important. So the database that kind of shows risk of all our individual projects. The fact that that is in itself, and access to that should be public good. It's a big action that's needed in the coming years. But I'm only saying that because you're EIB.
Okay, thank you very much. Just in a few words, Daniel, what did you organize this session? So first, thanks a lot to this whole event. You helped organize it. What are the key points?
Thank you so much. I think in few words, the first panel considered the question of, sorry, maybe I should. Yeah, we considered the question of how we can better integrate the risk dimension to inform adaptation finance, and I guess there is concentration of clear risk and asset level information, financial risk management. Basically, there is the question of that data limitations in terms of assessing climate finance risk. But I think the conclusion from the first panel is that more information, data is needed on climate risk, which needs to be granular. So we need to incorporate this climate risk assessment for companies, not only for companies and investors to make decisions, but also for insurers to make decisions, for countries to be able to make decisions, for local governments to be able to make decisions. The second panel, we consider the question of how different actors can better work together for better adaptation financing. And we concluded that, of course, there is a gap in adaptation finance, and more needs to be done in terms of addressing the political economic challenges relating to power and influence around that, and in terms of also, I think we concluded that I think there is a word that I want to go to what, because of time, what Michael said, in that we need more climate-related information in a way that decision makers and investors can use. I think that is very, very important. And so this talks about the synergy between policy and science, that we need to bridge that gap between science and policy, the science and policy interface, and that we need partnership. And I think it's a partnership already growing between Michael and David that they are going to explain there. Thanks very much for this. We want to actually thank our moderators and really for doing a very good work. Those people behind the scenes that have been very helpful in terms of coordinating and assisting. And Carlota, thank you very much. We are going to continue the discussions during lunch. When food is ready, you do less of talking. So please, thank you very much.
there.